If you were wondering what you have to do to become a millionaire, you're in the right place, because in this video, I'm going to be going over what you need to understand about becoming a millionaire. So make sure you watch this video until the end. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. There are 4 general ways that you can become a millionaire. The first way is you can be given this money. Maybe you win the lottery, maybe you win the genetic lottery, you have rich parents, or you have a rich uncle who just gives you $1 million. I can't help you out with who your parents are or who your rich family members are, so I can't give you much advice there, but that's one way that you can become a millionaire. Number 2 is you can make $1 million from your job if you have a very high paying job. If you are an executive at a very big company, if you are a super high paid professional, maybe a super high paid doctor, you can make $1 million. Now, again, this isn't something you can really do in a year, and this isn't something that I'm going to be talking about in this video, but it's another way that you can become a millionaire. Number 3 is you can become a millionaire through a business. If you want to make $1 million in 1 year, then you have to generate $2,740 a day. Now, we have 365 days a year, so if you do $2,740 a day times 365 days, that's $1 million. So this is assuming that you're making your $2,700 a day every day a week, including weekends and including holidays. So if you sell a product and you make $10 per product, that means you have to sell 274 products a day if you want to make $2,740 a day, which would make you $1 million in 1 year. Or if you want to make $1 million a year from your investments, and let's assume that your investments are paying you a 9% annual return on your money, in that case, you have to have invested $11 million. And if you have $11 million invested, now you'd be making right around $1 million a year. Understanding this is the simple part. Actually doing it is a little bit more tricky, and that's what I'm going to be talking about in this video, how you actually make the $1 million happen. But before we get into that, I need you to do me a quick favor and smash the thumbs up button below. Now, if you want to understand what it takes to become a millionaire in just a year, the first thing you got to understand is what's the difference between making $1 million a year versus being a millionaire. Making $1 million a year is what I just talked about. This means that your job is paying you $1 million a year. This means that you have your investments paying you $1 million a year, or this means that your business is making you $1 million a year. So $1 million a year means every single year you're making $1 million. Being a millionaire means that you are worth $1 million. The way that you calculate this is you take your assets and you subtract your liabilities, and then that gives you your net worth. So if you are worth $1 million, then you are a millionaire. So now you can add up your assets. Let's say you have $100,000 in the bank. You own your home worth $300,000. That's $400,000 worth of assets. And let's assume that you also have another $100,000 in the stock market. Now you have assets worth $500,000, and let's say you have $50,000 worth of debt. So $500,000 minus $50,000 is $450,000, which is your net worth. If you have assets minus liabilities worth more than $1 million, now you are a millionaire. So you could have $1 million worth of investments. You could have $1 million worth of rental real estate that you own. And this money, if you have a 9% return a year, that is $90,000 a year that you're making. So you are a millionaire, but you're not making $1 million a year. You have $1 million worth of assets, and these assets are still paying you, in this case, $90,000 a year, but you're not making $1 million a year. So you got to understand the difference between this and this. The next thing that you really have to understand is the hidden effort that it takes to become a millionaire. And the best way to think about that is just to think of an ice cube. So if you take an ice cube out of the freezer and you put it into somewhere where it is still cold, it is 10 degrees Fahrenheit. And now, if you take the temperature and you start to raise it up 1 degree at a time, you go from 10 degrees to 11 degrees to 12 degrees to 13 degrees to 14 degrees, the ice cube is not going to melt. And you can keep raising the temperature 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. And at some point you might think, I've raised the temperature so much, but the ice cube hasn't changed a bit. It is still ice. And now you go 26, 27, 28, 29, 30, 31. And if you stop at 31, you're going to say, well, I put in all this effort to melt the ice, but nothing has happened because the ice is still ice. And so you put in all this hidden effort between 0 degrees up to 31 degrees, and you haven't seen any change yet because the ice is still ice. But as soon as you make that one little small change from 31 to 32 and 32 to 33, now all of a sudden your ice is going to start melting. And so all you had to go was just that one kind of little degree more, and now you hit that breaking point. You hit the melting point, and now this ice is going to turn to water. And so the way to becoming a millionaire works the exact same way. You have all this hidden effort that you're going to have to put in, all this hidden work that you're going to have to put in that you might not see kind of where the results are, but as soon as you hit that breaking point, as soon as you hit the melting point, that's when the results come in. Like one person could be worth $999,000. They could have $999,000 worth of investments and still they're not a millionaire. And another person could be worth $100. For this person to go and become a millionaire, all this person has to do is get another $1,000 and now they're a millionaire. But for this person to become a millionaire, now they're going to need essentially a whole $1 million. The thing that everybody sees and that everybody gets excited about is how you go from $999,000 to $1 million because now you're a millionaire. But the hard part and the thing that requires all the work is how do you go from here to here? The final steps are going to happen faster and easier. And as you get closer to here, yeah, you'll be able to see much bigger returns in a year and go to that $1 million level. But when you're starting off here, going from here to here can take you a long time because you have to go through the learning curve. You have to learn how to attract more money. You have to learn how to invest your money. You have to learn how to grow your money. And so here to here is where all the effort goes in. And this is that process where everyone's trying to figure out how to become a millionaire overnight. But there's a lot of work required because right now your ice cube is at 10 degrees and you got to figure out how can you get it up to 31 degrees. Because once you get to 31 degrees, all you need is 1 degree more. And now you're getting the big changes. Now you're going to make the major changes because now you're hitting the tipping point. You hit that melting point where now you can really start to see the change. And in this case, that millionaire level. It is much easier to become a millionaire than it is to make $1 million a year. Anybody can become a millionaire. All you need is time and the right financial education. Because now what you're going to do is you're going to take some of your money and you're going to keep investing it. Now you're going to earn more money and you're going to keep investing that too. And now over time, you're going to slowly turn your money into $1 million by consistently growing your wealth, growing your money on the side, and keep fueling this fire by adding more money into that pit. Making $1 million a year requires you to now work to increase your income. Now, a lot of people are not going to be able to make $1 million a year from their job alone. It's just facts. And so what you're going to have to do is you're going to have to work to earn more money. Even 2 jobs are not going to cut it for 99% of people. So if you want to make $1 million a year, you're going to have to start your own business. You're going to have to create your own product and you're going to have to sell enough of this product to generate $1 million a year. So there's more risk required here and you're going to have to do different things than just work in a job, but it is possible. But here, this is possible for anyone when you have the right financial education. The last thing that I want you to understand about being a millionaire before we get into actually what you need to do is there's a difference between being a millionaire on paper and actually being a millionaire. So here's an example of that. Let's say you go out and you start investing your money and you buy yourself this rental property and you bought this property for a steal. You bought it for $150,000. Now, 10 years go by and let's assume that a lot of money flows into this neighborhood. You have new businesses coming in, you have a lot of people that want to live here, and now all of a sudden the property values in this area start skyrocketing and this property that you own is now worth on paper $1 million. And so now you own $1 million property and you bought this property for $150,000 and this other money, this $150,000 to $1 million is almost like imaginary money right now because that is what your property is worth. But you don't actually know that for sure until you sell your property because the price of any asset is determined by what it will actually sell for. Because you might think it's worth $1 million, but if no one's willing to pay you $1 million, then is it really worth $1 million? No. But in this case, let's assume that your property is actually worth $1 million and people are willing to pay you $1 million. Now you have this kind of like nest egg that's sitting there, this property that's worth $1 million, but this money isn't in your bank account. I mean, you can't go out and spend this cash unless you pull out a refinance on this property and now you have this cash in the bank that you can go out use to spend, but now you have to pay this money back plus interest. It's the exact same thing in the stock market. If you go out and you find a really hot stock that you want to invest in, let's just call it company X. This can be whatever company you want, and you put in $100,000 and a few years go by and this company takes off. This company goes all the way up tenfold and now you have $1 million in the stock. Yeah, you have $1 million on paper, but again, this $1 million isn't yours until you sell this property or you sell this stock. But you got to remember here as well that just because you're worth $1 million today doesn't necessarily mean you're going to be worth $1 million tomorrow here, because the stock market could crash. If that happens and your investment gets cut in half, now you're no longer a millionaire. And so there are pros and cons here, because yes, there's a risk to keeping all this cash in your hand, because now your cash is going to be eaten away by inflation. But there's also a risk to keeping your money in the investment, because if the market crashes, if property values fall, or if stock prices fall, now your investment value, your millionaire status, could also fall as well. In general, when it comes to preserving your wealth over the long term, you want to have your money in assets, not cash, because cash is always losing value, because as more money is printed, your cash gets diluted and your cash loses value. But assets over the long term go up. Yes, there can be crashes, but over the long term, if you have a good asset, it will hopefully continue to go up. This is where having a good strategy with your money and your investments is so important, because you want to make sure that you're protected against anything. So this could mean investing your money for passive income or cash flow. That's these properties. Even if property values fall, you still have enough cash flow to support you and your lifestyle. And that could also mean by diversifying your money into different assets or asset classes. That might mean having some money in stocks. That might mean investing in different stock sectors. That might mean investing in different stock markets across the world. That might mean investing in different assets like stocks and real estate, maybe cryptocurrency. Now let's go back to the original question of how can you actually become a millionaire. By the way, if you are interested in learning more about how to actually manage your money and invest your money, that's why we wrote a free guide on money management and investing, and you can read this guide for free when you sign up for our daily newsletter. So if you want to read our free guide and start getting a newsletter, I got the link to how you can do that in the description below. But one of the easiest things that you can do is create a financial system for your money. I like to call it our 75-15-10 plan. This is one of the things that I recommend. You don't have to follow this plan exactly, but just one of my recommendations. What this says now is for every dollar that you earn, 75 cents is the maximum that you can spend, 15 cents is the minimum you should be investing, and 10 cents is the minimum you should be saving. Once you have a good savings cushion, emergency cushion, this could mean somewhere between 3 months and a year's worth of expenses depending on your risk tolerance. You want to take this saving money and put it here towards your investments, because your investments are what's going to make you wealthy. And so the faster you can invest your money, the more aggressively that you can invest, the faster that you're going to hit this $1 million number or whatever number you're going for. That way you can build your wealth and stop working so much, because now you have your investments paying for your lifestyle. Now it's just a matter of math. If you can invest $625 a month, and you can get a reasonable 8% return on your money, which is about the average stock market and real estate return. Sometimes you'll see more, sometimes you'll see less, but that's kind of a good average. If you can maintain an average 8% return in 31 years, you will be a millionaire. If you can invest $1,000 a month, now it won't take you 31 years, assuming you can get the same 8% return. Now it's going to take you right around 25 years to become a millionaire. If you can invest $2,000 a month, now if you get that same 8% return, it's going to take you right around 18 years to become a millionaire. And just for some fun, let's assume now that you can invest $5,000 a month at the same 8% return. Now it's going to take you 10 years in order to become a millionaire. Now, obviously, it's going to take more money for you to invest more money. And this is where, okay, you have a financial system. Now, if you want to fuel this financial system, you have to have more money coming into your system. So maybe you're making money from your job and you can invest somewhere between $300 to $600 a month, depending on what your income is. If you want to start investing more money, you got to start making more money. So if you want to get to the $1 million figure faster, now you got to start earning more money, because you're already investing your money on the side to grow your income. Now, you could invest your money at a higher rate, but if you're working a job, you're not going to have the time to manage another full investment or kind of do these other active investments, because you want to work to just grow your income instead of just trying to grow your $625 monthly investment. So the two ways that you can get to that $1 million figure faster is 1, invest more money, or 2, invest more aggressively. Now, investing more aggressively comes with more risk, and that might not be something you're interested in or want to put all the time in. So you might want to focus on how you can grow this pie, how you can grow the amount of money that you're investing, and the only way you can do that is by earning more money. So what's the solution? Earn more money, and now invest this more money. That way you can become a millionaire. Now, there's a few different ways that you can earn more money. You can work harder at your job, you can get a promotion, you can try to get a raise, and if you do these things, this can give you more income that you have here, that you could put more money towards your investments. Another option could be for you to get a certificate or to try to get a different job that's going to pay you more money. Or if you want to make money outside of a job, now you can either get another job or you can try to start your own side hustle or side business. What you really really need to just kind of figure out where your passions are, something that you like, because if it's something that you like and something that you're good at, then you can make more money because you're actually skilled at what you're doing. The internet makes this more accessible than ever. Now, just because it's accessible doesn't mean it's easy, but you can create a brand around almost anything. You can create a brand around fitness, around finance. You can create a brand around cooking, around music. So if there's something that you like, you can build a brand around it. And if you can start to build a community or an audience, there are unlimited ways to monetize. You can do advertising, you can do sponsorships, you can sell your own products, you can be an affiliate for other products. All these things can start generating you more money. Now, this isn't something that's going to happen overnight. Again, it's like kind of melting the ice cube. It's going to take a lot of time and a lot of work to kind of get to that point, the tipping point, where now you can start making good money. But if you can put in that work, then there's a way for you to make money. And what you're doing doesn't have to be a digital company either. I mean, if you like making cakes, you can bake cakes and sell them to your friends, sell them to businesses and corporations when they have their events. And so you gotta just kind of figure out what you like and now turn this skill, turn this passion into something that can make you money. If you want to be a millionaire, you have to have $1 million worth of assets. For you to have $1 million worth of assets, you have to have some money. That way you can go in and buy assets. One way to get this money is from your job. But if this is not enough, or it's not going to take you there fast enough, you got to start making more money. How do you make more money? Well, now you can get more money from your job, you can work another job, or you can start a side business or a side hustle. So this side hustle is a way for you to earn more money. That way you have more money going into your funnel, more money going into investments. These are things that are going to make you wealth while you're working to earn more money. So you earn more money and your money works to build you wealth. We're going to jump back into the video in just a second. But before we do, here are a few words from our sponsor, Fundrise. But before I give you this advertisement, I do have to give you a disclaimer, which is that I do have some of my own personal money invested in Fundrise, and I also own some equity in the Fundrise company as well. If you've been thinking about investing in real estate, but you don't want to deal with the headache of property ownership, Fundrise makes it easy for anybody to get exposure to real estate investments with as little as $10. And now you don't have to worry about going out and buying a property yourself. You don't have to worry about managing tenants, and you don't have to worry about unclogging toilets. The way it works is you invest your money into Fundrise and you're getting exposure to a portfolio of real estate properties. And then you will get paid your share of appreciation and cash flow if your fund makes money. Remember, this is investing at the end of the day. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The nice thing about Fundrise, though, is now you can passively invest your money into real estate without having to deal with all the headache of property ownership. Second, Fundrise has an auto invest feature. That way, if you want to continually invest more money into real estate, you can do that through Fundrise. And third, they have a very cool dashboard that you can use to track the progress of your investments. Now, the last thing that I want to remind you is that when you invest your money in Fundrise or real estate in general, your money is not as liquid as it is when you invest your money into the stock market. So you have to remember, if you're going to invest your money in real estate, whether it's to buy an individual property or to invest your money into a fund through Fundrise, you are investing your money for the long term because you're investing your money in real estate. So if you want to learn more and see how you can start investing with Fundrise, I got the link to how you can do that down in the description below. Minority Mindset is a paid partner with Fundrise, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and see how you can start investing in real estate through Fundrise, I got the link to how you can do that down in the description below, where you can go to theminoritymindset.com/Fundrise. That's theminoritymindset.com/Fundrise. And with that, we'll go back to the show. I want to do something a little bit different today. Today, I'm going to create a checklist of the 10 steps that I would take today if I was starting over for zero and I wanted to build wealth, or I wanted to become a millionaire in my lifetime, assuming that I had credit card debt, assuming I didn't have any savings, assuming that I have other different types of debt, student loan debt and auto loan debt. What would I do today to start building wealth over my lifetime? So the 10 steps that I'm going to be going over, and I'll go over each one of these in detail in this video, is number 1, understanding the wealthy mindset and understanding the money rules. Number 2 is work to save my first $2,000. Number 3 is work to pay down my high interest debts, like my credit card debts. Number 4 is building a financial system, something like my 75-15-10 plan. Number 5 is managing my non-credit card debts, my lower interest rate consumer debts. Number 6 is making the decision of should I be paying down my mortgage versus investing my money. Number 7 is what do I do to get my cash flow exceeding my expenses for my investments? Number 8 is work to double my income. Number 9 is build my asset protection systems. And number 10 is how do I leave a legacy on this world? So let's go through each one of these steps one by one in this checklist, starting with number 1, understanding the money mindset and rules. On the simple side of the mindset, most of us, myself included, grew up with some sort of negative association with money. And if you grew up hearing things like, we can't have money, rich people are evil, money is bad, we can't afford nice things, what do you think you're going to think about money when you turn 25 or 30 years old? Well, if you grew up with all this negative association with money and you didn't go out of your way to start learning about money, chances are you are going to have a negative association with money, that money's bad, money's evil, rich people are bad, and that you can't become wealthy. And then when you go on to have kids, what do you think you're going to be telling your kids? Well, your kids are going to see you talk about money the same way you heard your parents talk about money. And if you grew up in a broke mindset household, your kids are going to grow up in a broke mindset household. And this is where it is very important for you to change the way that you think about money. And yeah, I know it sounds like a bunch of just fluffy stuff, but it is so important to believe that you can become wealthy, that there's an abundance of wealth in the world, and that you have the ability to achieve it. And if you don't believe that, well, I can guarantee it's going to be impossible for you. But this is where it is so important for you to believe that you can become wealthy, because the reality is there's a lot of money in the world. A central bank is producing trillions and trillions of dollars. All you need to do is get a small little sliver of the pie. That way you can build that wealth for yourself and your family and your future generations. And it is possible, but you have to believe it's possible. Let me show you. I've spent the last number of years talking about financial education and teaching financial education to people all over the world. And in the beginning, I used to think that money management and building wealth was just a numbers game. That if you make $50,000 a year, what do you need to do with your money to become wealthy? But as I began talking with more and more people, I realized that there's more to building wealth than just understanding what you need to do with your money. You have to understand the mindset. And the reason why is because if you don't believe that you can do it, you're not going to do it. You're going to self-sabotage the things that you need to do in order to become wealthy. And the thing that everybody wants is this. We want that outcome. That outcome is financial freedom. We want that cash flow. We want the wealth. We want to be rich. We could put whatever word that you want. But this is what everybody wants. We want the outcome. Now, if we work backwards, in order to get this outcome, you have to take certain actions. This is what you do with your money. This is what every other step that I'm going to talk about in this checklist is going to be going over. How do you save your money? How do you invest your money? How do you put your money to work? What actions you need to take to get that outcome. But in order to take the right actions, you have to have the right thoughts. Because in order for you to do something, you have to think how to do it the right way. And if you don't have the right thoughts to take the right actions, you're not going to have the right outcomes. And this is where what a lot of people do is they just say, change the way you think. And so how do you do that? Well, just start praying and meditating on this idea that I will become wealthy, I'll become wealthy, I'll become wealthy. And if you do that, you're going to be able to manifest wealth. But if you think that, but you have these subconscious thoughts, like these kind of pre-thoughts that in the back of your mind, you have this little voice saying, well, I know I'm just saying this so I can say it because that's what the person on YouTube says. Just say you can become wealthy, that way you can have the action and have the outcome. That's what the people on YouTube say. Well, if you have that little voice in the back of your mind, well, guess what? This whole system becomes broken. And that's where if you want to become wealthy, it's not just about the way you think, it's about really the way you believe. And it's about changing your subconscious. Now, I'm not going to have the time in this video to do a deep dive into how do you do that. But the simplest thing that you can do, if you feel like this is something that's going on with you, which is okay, that's normal, it can be changed, it can be fixed, but you're going to have to invest in your own personal development and your self-development. Start absorbing that content. Read books, watch YouTube videos, listen to podcasts, take classes, do whatever you got to do, but you have to change the way that you think about you becoming successful and wealthy, because if you have that little voice in your head, even though you might think that you're trying to change the way you think, unless you get rid of that voice and you truly believe that you can become wealthy and that money is abundant, it is going to be impossible for you. Once you understand this on the mindset side, that's where you want to understand the money rules. That way you understand why it's important for you to become wealthy. Outside of the government and our central bank, there are three main entities or stakeholders that make up our economic system. That is our C, the consumers, the I, the investors, and the B, the businesses. Now, every single person is a consumer. Rich people, middle class people, poor people, everybody's a consumer because everybody's got to eat. Everybody needs clothes, everybody needs a home. So everybody buys things, that means everybody's a consumer. But most people are not investors or business owners. So now, let's understand a little bit how this economic system works. Because the way that our economic system works is that you and I go to Chipotle to buy things. What does that mean? We are consumers. We are going to this business, which is Chipotle, to buy a bowl of Chipotle and get that extra guac. So now, you as a consumer are taking your money and you're giving it to Chipotle, and in exchange you get a Chipotle bowl, but the person that benefits financially is of course the owners of Chipotle. Now, who are the owners of Chipotle? Well, these are the investors in Chipotle. Anybody can be an investor in the Chipotle stock, but the people that make money when you spend money at Chipotle and buy that extra guac is, of course, the Chipotle business and the investors. But what you have to also remember is that in today's economic system, we have this thing called inflation. And inflation isn't something new. Inflation has been around for decades, but inflation hurts consumers. Because now when you want to go out and buy something, it costs you more dollars, right? You want to go to Chipotle, it's going to cost you more money today than it did 5 years ago because extra guac is more expensive, that bowl is more expensive. That is inflation at work. So now, in this economic system, we have inflation. We know that inflation has happened and it will continue to happen in the future. Now you might say, Jaspreet, how do you know that inflation is going to still exist in the future? Well, even if you go to the Federal Reserve Bank, they have a page saying that they aim for 2% inflation. The Federal Reserve Bank wants inflation. The government wants inflation, and the reason why they want inflation is because it helps keep spurring our economic system. So now what does inflation do? Well, inflation means that you might be making a little bit more money from your job because, well, incomes have risen over the last number of decades, although it hasn't risen fast enough with the higher cost of living, but that's besides the point of this video. Inflation means now you make a little bit more money, but now when you want to go buy the Chipotle bowl, or when you want to go shopping, you want to go on the vacation, you want to buy a home, whatever, you want to go spend money, it's going to cost you more money. So now more money is going into the hands of the businesses because you got to spend more money as a consumer. So inflation hurts consumers. But what happens now when businesses make more money? Well, they're making more money because they got to charge more money for their products, but that also benefits the investor because more money is going into the hands of the businesses, and the investors are what own the businesses. This is why this financial education is so important. It's because everybody's a consumer. We're all taught from day one how to be a consumer, how to buy things, how to like things, how to shop for things. But this is where the wealth is built. Now, you don't have to go out and start a business. You don't have to go out and start the next Chipotle, but every single person needs to be an investor because that's where the wealth is built. Not just that, our economic system is designed to benefit the investor because guess what? Our economic system is designed to create inflation. So now, if you don't understand this, you're not going to see why it's so important for you to change out of just being a consumer to being an investor. But the investors are the ones that benefit when our economic system happens. And our economic system is going to continue to happen. Inflation is going to continue to happen. Inflation is going to continue to hurt the average person while making certain people, like investors, richer, which is why you want to be an investor. But that's not all. Remember, our economic system is designed to benefit the financially educated. And as an attorney, who's not your attorney, what I can also tell you is that our tax code is designed to benefit the financially educated. Now, how do I know that? Because guess who gets the biggest tax breaks and the lowest tax rates? It's not the consumers who are just earning money from their job. It's the investors and the business owners. Because guess what? If we just assume now these are people who earn money from their job, if you earned $1 million working as a doctor or as a CEO versus you generated $1 million from your investments, who do you think is going to keep the most money at the end of the day? Now you might think, wait, $1 million as an investment and $1 billion from your job is the same thing. Well, maybe it is to you, but it's not the same in the eyes of the IRS or the tax code, because according to the tax code, you get to pay a lower tax rate on those taxes as an investor than $1 million from a doctor. And maybe you get more tax breaks as an investor versus a doctor. As a doctor, you might have to pay half of that money in taxes, which means you might be left with $500,000. As an investor, you might be paying 20% to 0% of the income in taxes, depending on how you invested your money and what types of investments you have. Meaning, after that whole tax bill, you might be left with $800,000 to $1 million. $800,000 to $1 million is a lot more than $500,000 after taxes if you earn that money just as an employee. Now again, not everybody has to go out to be a business owner, but this is why it is so important for everybody to understand these money rules. That way you can at least become an investor, because investors get to win in this financial system, not only because you have the ability to earn more money, but because you also have the ability to take advantage of the tax code, because the tax code is designed to benefit the financially educated, just like how our economic system is designed to benefit the financially educated. This is why you want to start with understanding the mindset and the money rules, and now we get into the practical side of what do you actually do with your money to build wealth, which is checklist number 2. Now that you understand that you can become wealthy and why it is so important for you to become financially educated, it's time for you to take practical steps with your money to actually become wealthy. And if you don't have any savings, the very first thing you got to do is save $2,000 to protect you against an emergency and put this money aside in a separate bank account that's there not to buy a home, not to buy a car, not to buy something from Gucci, but to protect you against an emergency. And the reason why you need to have this $2,000 put aside is because life happens. It happens to every single one of us. Maybe you get pulled over by a cop. Maybe something happens to your kid. Maybe something breaks with your car. Life happens. It happens to every single one of us. But if you're not prepared for this with some sort of financial cushion, you're going to be the one that pays the price, because now either you're going to have to sell out your investments, which you didn't want to do at that time because the markets just happen to be crashing when that emergency happens, or maybe that means you're going to have to go into credit card debt, which is actually what most people end up doing when an expense comes up and you don't have the money for it. Now, not only do you have to pay $2,000 to cover the broken water heater, but then you're gonna have to pay an additional $800 in interest on your credit card to pay it back because you weren't prepared. And that's why you wanna be prepared, because life happens, we know this. And the wealthy are working to be prepared. So the first thing that I'll be doing now in the practical steps is work to save $2,000 as fast as possible and do whatever I need to do to save the $2,000 and put it aside in a separate savings account. And this is not money that I'm going to use to spend at Gucci. This is money that's there to protect me against an emergency. Once I do that, then the next thing that I'm going to do is work to pay off high interest debts like credit card debts. And the reason why I'm going to do this, before I think about investing my money, before I think about putting my money in the stock market or doing any of that other stuff, is because I know that these credit card companies, if I have credit card debt, is costing me 15, 20, 25, 28% a year in interest, versus the historical stock market return over the last century is something like 10% a year. So now, if I can work to pay down my credit card debt 1 year faster, I'm going to get a better return than investing my money in the stock market. Not to mention, I'm going to get a guaranteed return by paying down my credit card debt, versus by investing my money in the stock market, I'm hoping to get a good return. And this is where it is so important for you to get very aggressive here to pay down this credit card debt, because this is what holds so many people back from ever becoming wealthy. Because when you're constantly in credit card debt, you can't think about building your wealth upwards. All you're trying to do is get to zero. And that's why during these 2 steps of this checklist, you have to be extremely aggressive. That means during this phase, you're gonna have to make financial sacrifices. That means maybe you gotta stop eating at restaurants. Maybe you gotta cancel that vacation. Maybe you gotta live in a smaller apartment. Maybe you're gonna have to sell the BMW. And these are financial sacrifices that are very hard to do, but until you get committed, it is gonna be extremely difficult for you to get to even zero on your wealth scale. I want you to get to $1 million and beyond, but you can't get to $1 million and beyond until you at least get to zero. And if you're stuck here, you're just running in circles trying to get to zero. And that's why you have to get extremely aggressive. And what I like to tell people is, until you have this done, until you have your credit card debt paid off, and until you have this $2,000 saved up, you shouldn't even have a Netflix subscription. Now you might say, Jaspreet, what the heck are you talking about? Netflix is $15 a month. What difference is that gonna make of me saving this $2,000 and having this credit card debt paid off? Well, what you have to remember is the real cost of Netflix isn't the $15 a month that you gotta pay. It's the 2 hours of your life that you're investing into Netflix, when you could be using that time to learn more about how do you earn more money, how do you pay down your debts, how do you build your financial education, how do you build a business, how do you improve your career, how do you get a different certificate, how can you improve where you are financially. And if you don't have these 2 things done, you are in what I like to call the financial danger zone. And if you are in that financial danger zone, you should not have the comfort or luxury of sitting there watching Netflix when you are paying 25% a year to the credit card company. Because that 25% a year that you're paying to the credit card company is making them rich at your expense. And I want you to make yourself rich instead of them rich. But in order for you to make yourself rich, you gotta make those sacrifices to stop making the credit card company richer, and you gotta have this $2,000. That's why I'm so passionate and aggressive by these 2 things, because if you don't have this, you're never gonna have the opportunity to ever build wealth, which is why you need to get very aggressive about this and work to pay down the credit card debt aggressively, get rid of the Netflix, spend your time and spend your money figuring out how you can get out of the system. That way you can at least get to zero, because once you get to zero, now it's all about how do you build upwards. So now that we got this done, let's move on to number 4, which is now building a financial system for your money following something like a 75-15-10 plan. Now, after I work to pay down my credit card debt, this is where I need to give every dollar that I earn from here on out a job. I didn't need to do that before, because before, every time I had an extra dollar, either I'm going to work to save that $2,000 or I'm going to use that extra dollar to pay down my credit card debt. Now that I've zeroed out my credit card debts, now that I have a couple grand in the bank, this is where I have a little bit of financial cushion and I can use my money a little bit more strategically, and this is where I want to be proactive, because I know what wealthy people do is they have a plan for their money before they earn their money. But what everybody else does, what the majority of people do, is they make money, they spend their money, and then they wonder where all their money went. No more of that. And this is where I would want to build a financial system, something like a 75-15-10 plan, which says for every dollar that I earn from here on out, 75 cents is the maximum that I can spend, 15 cents is the minimum that I'm investing, and 10 cents is the minimum that I'm saving. Now, the whole point behind this is this savings money is there to protect me against an emergency. This investment money is there to make me wealthy. This spending money is what I use to look rich. This is what I use to eat. This is what I use to pay for my home. This is what I use to pay for my car. This is what I use to pay for everything else, all the things that are not really there to make me wealthy. These investments are there to make me wealthy, and this investment is not money I'm using to buy a down payment for my home that I want to live in. These are true investments, and this 10 is my savings cushion to protect me against an emergency. Now, the first question that I always get when I talk about this is, well, Jaspreet, should this be gross income or should this be net income? Should this be my pre-tax income or post-tax income? And the thing that I like to say here is your investments are what's going to make you wealthy. The more money you invest, the wealthier you're going to become. But you have to just get started. Because if you have no investments right now, just get started. Start with your pre-tax income. Start with your post-tax income. It does not matter, but you got to get started. You want to invest more aggressively here. That way you have more money to invest. And so this is where you don't want to necessarily get caught in the nitty-gritty of things, but just get started. If you can't start with 75, 15, 10, start with wherever you can, and then keep working towards 75, 15, 10 of every dollar that hits your bank account. And then maybe you can be even more aggressive with your investments. Maybe you work to make this 70, 20, 10. You do what's right for you, but remember, the more aggressively you invest, the more wealth you'll be able to potentially build, because now you're putting more money aside into your investments. Now, I'm not going over just yet where I'm going to be investing money. I'm going to be saving that in the coming steps of this checklist. You'll see just why. But the first thing that I want to do is I want to create this funnel, this system where I know my money is being separated. I know that this is the max that I can spend. This is the minimum that I'm investing. This is the minimum that I'm saving. And ideally, you're going to create 3 different bank accounts, because now you don't want to accidentally spend this money or spend this money. So create 3 different bank accounts. That way when you get paid, your paycheck goes here, and then you have an automatic pool of this money that goes into a different account and a different account. So you have 3 different bank accounts, and most banks will do this for you for free. This way now you know which cash is supposed to be there to make you wealthy, to invest for you. You know which cash is supposed to protect you against an emergency, and you know which cash you're supposed to use to buy that extra guac. Now, we've gone through the first 4 parts of this checklist. I got the mindset and the rules down. I saved my $2,000, I paid off the credit card debt, and now I have 3 different bank accounts, 75, 15, 10, that I'm following with this financial system. But remember what I said in the beginning part of this video, which is that I'm assuming that I have other loans as well. Student loans, auto loans, other things like that, those lower interest rate consumer debts. Let's talk about now how I would manage that debt right now for me personally. The way that I would go about this situation is I would continue following 75, 15, 10. But instead of taking this 15 and putting this money into the stock market, I would take this money and use it to pay down those low interest rate debts, except my mortgage. So I would use this money to more aggressively pay down my student loans, to more aggressively pay down my auto loan, and whatever other lower interest rate debts that I have. Now, you might be wondering, but Jaspreet, you said earlier that the stock market has averaged 10% a year, but some of my lower interest rate debts, like my student loans, are 6 or 7 or 8%, and my car loan is 6 or 7%. Isn't that 10% return from the stock market higher than these lower interest rate debts that I have? Yes, but you got to remember that stock market return is an average. It's not a guaranteed return. And if I'm trying to figure out how do I build the most wealth, I want to go after the guaranteed returns first before I now start putting my money to grow into the markets and other places like that. And so what I would do in this situation is use this money to pay down my auto loans, to pay down my student loans, and get out of those expenses, because that's also going to give me a little bit more breathing room, because when I stop having that money leaving my account, well, now I have a lot more financial cushion, and I want to make sure that I have the financial breathing room and a little bit more of financial just space to do whatever the heck that I want. Which is why the first thing that I would do is pay those things off. Now, ideally, you're going to be more proactive with these things. That you're not going to go out and finance a car that you can't afford. You're going to go out and buy a car with cash, even if that means you don't get that BMW. Now you're driving a Toyota Corolla a little bit longer, and maybe the Toyota Corolla has some dents on it, but now you don't have to worry about those payments. And maybe that means you don't go into student loan debt. Maybe that means you change the way you go about college, you go to a cheaper college, or maybe that means you work through college. Whatever that might mean, ideally, you're going to change the way that you get these debts so you don't have to do this, because your investments are what's going to make you wealthy. And you want to start investing your money as soon as possible. But if you have a whole bunch of debts and expenses, I would want to get rid of those debts, those consumer debts, the things that are not making me any money as fast as possible, because I know that 5, 6, 7, 8% that I'm paying to them, well, if I pay that off a year early, that's a guaranteed return, versus the 10% of the stock market isn't. This brings me to number 6 on the checklist, which if you are a homeowner is, should I pay down my mortgage or should I invest my money? Or the alternative, should I buy a home or should I invest my money? So let's dive into that one. Now, if you remember what I said just a minute ago, when it comes time for me to use this money, the first thing I wanted to do myself is I want to pay down my student loans, I want to pay down my car loan. I did not talk about the mortgage. The mortgage is a little bit of a separate question because, well, mortgages can be a little bit tricky. Because while I don't consider my home an asset, I do understand that there can be equity built in that home by paying down that mortgage. And now sometimes some of you might have a much lower mortgage rate on your home. And this is where the question can be a little bit more different. And so now if I was answering this question for myself of should I pay down my mortgage or should I invest, the first thing I'm going to ask is, what is the interest rate on my mortgage? If my mortgage is sub 5%, it's going to be a different answer than if my mortgage is above 5%. Because if it's sub 5%, well, now I have a better likelihood of investing that money in the stock market or something and beating that return. And even if I didn't put that money in the stock market, well, I could put this cash into a high interest savings account and I can generate 4.5% to 5% a year in interest from a high interest savings account and use that money to pay this down if I have a 3.5% mortgage. So that's the first question that I would ask. Second question that I would ask myself is, what is my risk tolerance? Am I somebody who wants to just live financially free and just be comfortable, or am I somebody that wants to live a little bit bigger? Now for me, I have a little bit of a higher risk tolerance. I don't have the highest risk tolerance, but I have a little bit of a higher risk tolerance and I have bigger financial goals. So for me, because I have the higher financial goals, I know that I don't just want to be comfortable. I want to have the ability to build more extreme levels of wealth. I'm going to have to take different types of risks and I have to do different things with my money, which is why for me, especially if my mortgage is under 5%, I'm going to be more aggressive with my investments as opposed to just paying down my mortgage. Now, if my mortgage is 6, 7, 8%, now it's a little bit of a different question because now maybe I'm going to pay down my mortgage a little bit more aggressively while also investing my money. I want to be investing my money, whether it's in my own business, whether it's in stocks, whether it's in real estate. I want to be investing my money, but this is where now understanding, well, kind of where the mortgage is going to change how I play this game. If I have a 2.5% or 3.5% mortgage, I'm going to continue paying the mortgage and I'm going to be investing my money other places as fast as possible. Now, the other thing that I would like to talk about here is, for me, ideally, if this was an ideal world, I'm going to go out and buy a rental property before I go out and buy my own home. That's what I did. I became a real estate investor before I even thought about being a homeowner. But now, if I was in a situation today where home prices are extremely expensive and I'm trying to think about should I buy a home or should I go keep renting and investing my money, well, the key question that I would want to ask here is, what is the more affordable option for me? Because I don't look at buying a home as this ability to build huge generational wealth and build my wealth, because I want to build my wealth from rental properties, I want to build my wealth from my stocks, and I want to build my wealth from businesses that I build or own. I don't want to build my wealth through paying down my home. I know that's what a lot of people like to talk about, but that's one of the worst ways to build wealth or build generational wealth. And if you don't believe me, ask any wealthy person how they became wealthy, and they'll tell you they became wealthy because they invested their money in stocks, or they became wealthy because they invested their money in real estate, or they became wealthy because they built a business or invested in a business or something along those lines. They don't say that they became wealthy because they paid down their home. So I'm not saying being a homeowner is bad, just understanding how that plays a part in your investment portfolio. And this is where now, if I'm thinking about the home buying question, it's not really should I buy a home or should I rent a home, it's what's going to give me the ability to continue investing my money into the real things that's going to make me wealthy. Stocks, real estate, my own business, or other businesses. What's going to give me the ability to do that? If I can own a home and I can keep doing that, fine. If I can't, then I'll keep renting. The key is to be able to live wherever you can afford. That way you have the money to buy the assets that will continue paying you, that will continue making you wealthy, instead of just stretching so thin just to own a home. And the funny thing is, well, I used to be a licensed realtor. I still am, but I don't work as a realtor. But when I used to work as a realtor, every sales training talks about how now when you're talking to a buyer, what are you saying? You're telling them that they're buying this big investment, the biggest purchase of their life, the biggest investment of their life. And when you sell this home as an investment, it's much easier to get you to buy a little bit bigger, to buy a little bit nicer, because you think it's this nice investment. And then what it ends up being for the majority of people is a big money pit. You're just sucking money into this home and you no longer have money to invest because you just think that you're building wealth by building equity in your home. But if you really want to build wealth, it's not just by building equity in your home, it's by building equity in the stock market, rental properties, and through businesses that you own or invest in. That's where the real equity is that will make you wealthy, is not the home that you live in. Now sure, is that equity in your home that you live in good? Yeah, but I would rather have the equity in the stocks, rental properties, and the businesses than just the home that I live in. So understanding that question and making sure now that whatever I do is not going to sacrifice my ability to keep investing my money. Moving on to number 7 in this checklist, which is now getting my cash flow to exceed my expenses. So now let's go back to the 75-15-10 diagram. When I actually start investing my money into assets like stocks or real estate or into my own business to build wealth outside of my 401k, by the way, if 401k is giving you a match, continue doing that earlier because that's kind of like free money you're getting from the company. But now when I'm thinking about where I want to invest my money, I like to generate cash flow. And by cash flow, that means that I own something and this thing pays me every month or every quarter, every year just for owning it. That's what I like. Now, not everybody likes cash flow because when you generate this type of cash flow, you have to think about taxes. Because every time you get paid, you have to think about taxes. Now, of course, when you make money from your investments, you qualify for certain tax deductions or tax breaks or lower tax rates because that's what the tax code says. However, you still have to think about taxes when you generate cash flow. Versus the alternative is investing your money for appreciation, which is I go out and I buy this investment for $100 and then I have to hope that it goes up in value to $200. Now, neither one of these is right or wrong. You just have to figure out what's right for you. Personally, I like investing for cash flow. That's why the bulk of my investments are cash flow investments. So now, where would I be putting this money? Either I'm going to use this money to go out and buy rental properties that's going to pay me with cash flow, or I'm going to use this money to go out and invest in dividend-paying stocks or dividend-paying funds that are going to pay me with cash flow, or I'm going to use this money to go out and invest in my own business. So depending on where I am in my career or what I'm interested in or what I want to do, that's where I'm going to go out and invest my money. But the goal now is for me to generate this cash flow and then take this cash flow that I'm generating and keep investing it back to get more cash flow. If I invest in dividend-paying companies or dividend-paying funds, I'm going to keep investing into it every single week. Every time I get paid, I want to be as aggressive as possible. I'm going to try to do more than 15 if possible, and I'm going to keep investing my money to generate this cash flow. In the beginning, the first couple of years, you get nothing. It's peanuts. It makes no difference. But the goal and the real key to becoming wealthy here is you keep investing your money more and more aggressively as you generate more money. That way you can generate more cash flow with every dollar that you invest. And then when my cash flow makes money, when I get paid with those dividends, I reinvest those dividends so I have more money going out to buy me more cash flow. So every time I make money, I'm buying cash flow. When my cash flow pays me with cash flow, I'm using that to buy more cash flow. And then understanding the decade of sacrifice. It's understanding that building wealth is a long-term game. And the way the decade of sacrifice works is I'm going to be working over this decade to spend less and earn more. That way I have more money to invest like crazy. Because if I can stick with it for a decade, I'm going to be in a completely different financial situation in 10 years. And in 10 years, I know that if I stick with that, I'm going to have some significant cash flow coming in. And my goal is to stick with it until my cash flow can exceed my expenses. Until my monthly cash flow can exceed my monthly expenses, I'm going to keep reinvesting this money. I'm going to keep being aggressive with this cash flow because this is the goal. When I have enough cash flow coming in from my dividends or from my rental properties, well, now I am financially free. And that's why I want to be aggressive until then. And yeah, it is going to take time. It's not going to happen in a year. It's not going to happen in 2 years. It's not going to happen in 5 years. It could happen in 10 years, depending on how aggressive you are and where your expenses are. But this is where now it is important to stay aggressive here to keep reinvesting the cash flow. And for me, I'd keep doing that until my cash flow can exceed at least my basic expenses. Maybe not my lavish expenses, but at least my basic expenses, because then that's going to give me the opportunity to be more financially free. This brings me to the 8th part of this checklist, which will help me get to the cash flow exceeding my income part, which is how do I double my income? And how do I double my income as many times as possible? That way I can keep earning more money. Now, that might sound a little bit unrealistic, but this is where I want you to start being a little bit unrealistic. Because if you really want to become wealthy, remember what we talked about here, you have to believe that it's possible for you. And the people that can actually become wealthy, well, guess what? They believed it's possible for them. And this is where now I want you to think. If you're making, let's just say $50,000 a year, what would it take for you to earn $500,000 a year? To add another zero to that. Now, as soon as you hear me say that, you might say, Jaspreet, what in the world are you talking about? How in the world do you expect me to go from $50,000 to $500,000? But if I said you had to figure out how to do that, what would you do? Maybe you'd start watching some YouTube videos on how to earn more money. Maybe you'd start reading some books on how to earn more money. Maybe you listen to some podcasts. Maybe you take some classes. Maybe you start trying things. And now you start experimenting on how to increase your income. And guess what? There are ways for you to turn your annual income into your monthly income. People have done that. And then there are ways to turn your annual income into your weekly income. People have done that. And there are ways to turn your annual income into your daily income. People have done that. Now, of course, is that very likely? No, but people have done that. And this is where you don't have to kill yourself and drive for the rest of your life trying to just increase your income. But if you really want to get to that wealth sooner rather than later, if you want to increase your cash flow, you got to put some effort into here. How do you increase and double your income faster? And there's a lot of education out there on how to do that. Now, there's going to be a lot of mistakes made by you. Every single person goes through that. I went through that multiple times. There's going to be a learning curve. There's going to be that hurdle. There's going to be that time involved. There's going to be that stress involved. There's going to be that risk involved. That's all part of the game. You can't avoid that. There's no like, oh, you just do this, this, and this to double your income. That's not what I'm talking about, okay? That's a bunch of other people on the internet that are selling crap on how to just make $10,000 a month doing nothing. That doesn't work. What I'm talking about now is how do you actually work to increase your income? How do you increase your skill set? How do you sharpen your skill set? How do you increase the value that you can provide somebody else, your business or whatever, to earn more money? And this is where you want to be starting to invest into that as well. Maybe that means you get a career change. Maybe that means you work to get a certificate. Maybe that means you work to get a job change. Maybe that means you start a side hustle. Maybe that means you start a business. You got to figure out what's right for you. And one of the funny questions that I get asked is, Jaspreet, what business should I start? I don't know. I don't like this idea of just going out and doing X, Y, and Z, going out and doing Amazon fulfillment or doing e-commerce or doing whatever people talk about on the internet, because that's not a real business to me. And there's a lot of failures involved with that. And you're just kind of just following somebody else's system. That to me is not entrepreneurship. Entrepreneurship is innovating, creating something, building something that you are passionate about, where you believe that you can actually impact the world. And you got to figure out where that value is for you. Maybe you don't start a business. Maybe you don't start a side hustle. Not everybody should be an entrepreneur. Maybe you're going to work in your job. Maybe you're going to work in your company. Maybe you're going to ask your boss. Maybe you work to get a different job or a certificate or something. But you got to work now to increase your income, to increase the value that you can provide as a person. That way you can earn more money. And now as you earn more money, you continue following that financial system. If you keep investing your money more aggressively, well, guess what? Now you have more money going to buy you more cash flow. You have more money buying you more investments. That we can get to that wealth number even sooner. This brings us to point 9 of the checklist, which is asset protection. As you start building your wealth, you need to start thinking about how do you protect your wealth. That means now talking to the right people, talking to the right advisors. That means on the legal side, how do you have lawyers there to protect you? Because when people realize you have money, they're going to try to take their hands, put it in your pocket, and take some of the money for themselves. I told you earlier in this video that I started investing in real estate earlier on. And when I started investing in real estate, I had no idea what I was doing. And as I started getting involved with real estate, I had a not so good tenant in my first property. And the not so good tenant ended up suing me. Well, actually, she sued my real estate company. And the reason why she sued my real estate company was because she claimed that the bathtub was too slippery when the water was on. True story. And she wanted to go after the quote unquote rich landlord for some money by getting one of those free attorneys. I had no idea what was going on. I was a young kid. I think I was 20 years old or 21 years old at the time when the lawsuit came in. And I didn't really know how to handle it. But I had insurance. Insurance worked to settle the claim, and the other party didn't actually win anything because we found out that they didn't actually slip and fall in the bathtub. They slipped and fell at a friend's barbecue. But all this to say, you want to make sure you have the right advisors, because guess what? In this world, people will try to come after you when they realize you have money. So you want to make sure you have the right legal protection there. You want to start thinking about estate planning. Even though you might be young, you want to start thinking about what happens if you were to pass away. How do you get the right estate planning in place? Talk to an estate planning attorney. You want to make sure you have the right financial guidance. Get a good tax advisor. Guess what? The IRS tax code is a tax code. It is a rule book. And you want to make sure you have a good advisor that can guide you on how to use the rule book to pay the least amount of money in taxes legally. So you want to start investing in this asset protection as you start to build that wealth. And of course, you want to think about now, how do you leave that legacy as well? How do you give back? How do you help other people? Because at the end of the day, as you work to build that wealth, you're going to have the ability to help other people, not just through more money, but also through your time. And this is very important now. As you build your wealth, as you start to fill your cup with water, how can you help fill other people's cups? Because if you have an empty cup of water, you can't give anybody else water. But as you start to fill the cup of water with water, and by water I mean that wealth here, now you have the ability to fill other people's cups of water. And the nice thing here is as you start to build that wealth, you can help to fill other people's cups of waters without really draining your cup as well. And again, it's not just necessarily through money, but also through your time and through your education. And how can you help other people? Because you want to leave a legacy and not just keep everything for yourself, because you can't take all this money with you, but understanding how you can help others and how you can leave a legacy in the world.
We're going to jump back into the show in just a minute, but first, here's an advertisement from our sponsor, me, with Briefs Media. If you're looking for an easy way to stay up to date on what's happening in the top finance and business news, we make it super easy for you to do that at Briefs Media because we created a free newsletter called Market Briefs. Market Briefs is a super simple and easy way for you to stay up to date on the top finance and business news. You can read Market Briefs in less than 5 minutes every morning. It's a fun and witty and easy to read newsletter, and I promise, if you join Market Briefs, you are going to love it. Now you might say, Jaspreet, how can you promise that I'm going to love Market Briefs? Well, if you don't love Market Briefs, you can unsubscribe at any time because it's completely free. So if you have not joined Market Briefs yet and you want to stay up to date on what's happening in the top finance and business news, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And with that, let's go back to the show.
Let's talk about investing for cash flow, because unfortunately there's a lot of, let's call it poo-poo information out there on the internet when it comes to the topic of cash flow investing, because a lot of people say, oh, if you want to get rich, just get this passive income, create this drop shipping site, start this Amazon store, create this ebook, and you're going to be making passive income, this cash flow. But the reality is, number one, that's not passive. And number two, it is so difficult to generate this type of cash flow. The way that real cash flow investing works for investors and help people become extremely wealthy with cash flow is like this. I'm going to draw you right here for my male followers. I'm going to draw you a mustache, and for our female followers, I'm going to draw you a braid. In my native language Punjabi, we call a mustache a much and a braid a gut. So now you go to work every single day at this job. Maybe this job is your business, and then this job is going to pay you a salary. Now you're going to take a piece of the income that you did not spend at Gucci and Chipotle, and you're going to take this money and you're going to invest it into this asset. Now this asset could be something like a dividend paying stock. It could be something like real estate. I'll talk about how you can do this in just a minute, but now you're going to take this money, put it into this asset that's going to be generally passive on your end. Not completely passive, but generally passive. And now that you own this asset, it is going to pay you with cash flow. Maybe you get a check every month. Maybe you get a check every 3 months. Maybe you get a check once a year. Just depends what this asset is. And now you can take this money that you're generating and you can either buy more of these assets that are going to pay you with more cash flow, or you can take this money and use it to go out and buy you a brand new car. That's going to be your choice, but this is how real cash flow investing works. Now, the thing that you need to understand about cash flow investing that nobody wants to talk about on the internet is that you don't get rich by investing for cash flow. You got to be rich first to get a lot of the cash flow that will make you wealthy. The reason why is because you got to take the money that you're earning that you don't spend at Chipotle and Gucci, and then you take this money to buy these assets. So you need the money to generate the cash flow in the first place. And this is why it's so difficult, is because people hear this idea of generating passive income and cash flow, and it sounds very exciting. But the reality is, when you generate this cash flow, you're generating a return on the money that you invest. So let's assume, I'm going to be very generous here. Let's assume that you can get a 10% cash flow return. That's very high, by the way. But let's assume you can get a 10% cash flow return. That means if you invested $1,000 into this asset, you're going to generate $100 after 1 year of cash flow. $100 from $1,000 is not going to really pay you much. I mean, it's not going to fund really anything in your life. Even if you invested $100,000, then you're only generating $10,000 a year. Now, $10,000 a year is a lot, but it's not even $1,000 a month. It's not life-changing money for you to go out and start driving a Rolls Royce. You need the money to invest to generate the cash flow. This is where people say, but Jaspreet, if I need millions of dollars to generate a lot of cash flow, what's the point of me even doing that? Well, the point isn't for you to go and invest into this cash flow asset today and never do it again. The point is you go to work every single day. You get this paycheck every week, every 2 weeks, every month. Every time you get paid, you're going to take a little bit of this money and buy this asset. Now, when you do this week after week after week, month after month after month, year after year after year, decade after decade, now you're going to be building a solid stream of cash flow, especially if you're taking this cash flow that you're generating and using it to buy more assets, because now you're making money to buy cash flow, and the money that your money makes is buying you more cash flow as well. And now if you do this for long enough, now you're going to be able to build a solid stream. Now, the more money you invest into this asset, the more cash flow you're going to be able to generate. And this is why I call it the decade of sacrifice. Because if you put in a decade of time where you're working to live smaller so you have more money here, and then you take this money and you use it to buy these assets that are paying you with cash flow, well, now after a decade of sacrifice, you are going to be able to reap the rewards of that, which is now you're going to finally have a solid stream of cash flow. So if you want to go through this decade of sacrifice, which is not easy, I mean, it's the reason why the majority of people will never become financially successful or wealthy. The majority of people do not want to make this financial sacrifice of you working to live smaller and earn more money, not so you can drive a BMW, not so you can buy all the fancy Gucci, not so you can have a big home, but so you can have more assets. And if you put in that work to own more assets that are paying you with cash flow, now you got the checks coming in every month, every quarter, every year, and now you have this money coming in without you physically working, because remember, you got to work here to get this check. You don't got to work here to get this check. This asset cash flow is coming in passively. The only thing you got to do here is make sure that your assets are still good, making sure that you still own a good portfolio of stocks, making sure that your real estate is still good. All you got to do here is monitor it. Here, you got to go into the office or go into work and keep getting that paycheck, because if you don't work, you don't get that paycheck. Here, if you don't work, you still get paid. But in order to get paid here, you got to keep contributing money here week after week, month after month, year after year for at least a solid decade. And if you do that, now you're going to have a brand new stream of income that can allow you to drive that nice car without worrying about the price. You have the money coming in here that will allow you to go on those vacations and not have to worry about the price. You got the money coming in here to buy the fancy clothes. And you don't got to worry about paying for it, because it's your assets that are paying for it. It's not what you are working to pay for. This is how wealthy people really become wealthy, because if you can build this type of cash flow, well, now you have true financial freedom, because now you have assets that are paying for your lifestyle instead of just you working to pay for your lifestyle. This is what it means to become wealthy, because now it's your assets that will fund your finances. So what are these types of assets that you can invest in? That way you can generate this type of cash flow. Now, I'm going to go over mainly two types of assets. I'm going to talk about stocks, and I'm going to talk about real estate, because these are probably the two most accessible ways for the average person to generate this type of cash flow. When you go out and you invest in a company in the stock market, what you're doing is you're literally buying a business. If you go out and you buy one share of the Amazon company, you become one of the owners of the Amazon company. If you go out and you buy one share of the Apple company, you become one of the owners of Apple. If you go out and you buy one share of Chipotle, you become one of the owners of Chipotle. If you go out and you buy one share of Sweetgreen, you become one of the owners of Sweetgreen. You get the idea. Now you're literally buying one of the pieces of ownership in that business instead of just buying a product that this business sells. Most people just think about businesses as their products. You go and buy things on Amazon. You buy the newest iPhone. You buy a Chipotle bowl. You buy a Sweetgreen salad. That's how most people are wired to think. When you go out and you invest in a stock, now you're actually buying the business instead of the product. Well, some companies in the stock market, not all of them, but some companies on the stock market pay what's called a dividend. A dividend is a cash payment that you get as an investor for doing nothing except owning the stock. Now again, not every company pays out a dividend. And the reason why is because for a company to pay out this dividend, they have to have a big profit. So now when a company makes a profit at the end of the year, there's three things that they can do with this cash. Number one is they can save this money in case of an emergency. Number two is they can reinvest this money back into the company. Or number three is they can just give it away to you, one of the shareholders, one of the owners. Now, when it comes to saving the money in a company, you got to think from the perspective of a business owner. If a company makes $100 million of profit and they kept $100 million in their bank account, well, that's dead cash sitting there. Not every company wants a ton of dead cash sitting there because the $100 million isn't generating a return for the company. Companies want to do something with their money or at least give this money to their owners. And so if a company has a big enough bank account or a big enough savings account, they might not want to save more money, which then brings us to option two, which is reinvest the money back into the company. Now, if it's a smaller startup growth company, you bet they're going to want to invest all of this money, maybe and some more, through debt and other investment money back into the company because they want to grow bigger. They want to expand their market share. They want to be a larger company. And when a company is trying to grow, they're going to be investing everything that they can to open new stores, open new manufacturing plants, open new research and development facilities. That way they can keep expanding and growing their market share. But when a company becomes even bigger, and now you're a much larger conglomerate, and you don't really see that opportunity to keep investing and growing as quickly, now you might not want to reinvest all this money back into the company, which leaves now this cash back in the bank account. And if you don't want to just save it, well, then you can give this money away to the shareholders, people like you who own a piece of the stock. Now, this is called a dividend. And companies that pay a dividend generally pay out this dividend quarterly, meaning every 3 months. So now, if you buy a stock that's paying a dividend, that means you're going to get a cash payment every 3 months for doing nothing except owning the stock. Now, does this come with risk? Of course. If you invest in a company on its way to bankruptcy, well, eventually they might cut that dividend, or they'll have to cut that dividend. Plus, you could also see the value of that stock fall. And this is where you have to understand how to value an investment and know how to research a good stock. And you might be saying, but Jaspreet, I don't want to do all that. I don't want to keep up with the company. I don't want to research the stock. I don't know how to do that. I don't want to research the financials. That's okay. You don't have to. The alternative to investing into an individual company is to invest in something like a fund, maybe a dividend-paying ETF, a dividend-paying index fund, a dividend-paying mutual fund. Now, instead of investing in one company like, let's just say, Apple, now you can invest into a basket of companies that have, say, 500 different companies in here, and Apple is just one of the companies, and there's 499 other dividend-paying companies in here. So now you can go out and find these dividend-paying funds. Again, you have ETFs, mutual funds, index funds. You go out and find one of these dividend-paying funds that invest in companies that are paying a dividend. Now you invest in one thing that's investing in 500 different companies. Now you can lower your risk because if Apple were to go bankrupt, well, now you have 499 companies to balance it out. This way you can lower your risk and keep getting those dividends. That way now you can just keep throwing your money into one of these funds. So this is option one. You can invest into an individual company. I am not telling you what to invest in, just giving you an example. You can invest into an individual company that's paying a dividend, or you can invest into a fund that's paying a dividend. But again, the key is you got to just keep reinvesting that money. Option number two is you invest in real estate. Now you're going to go out and buy a property. Maybe it's a house, maybe it's an apartment complex, maybe it's an office building if that's something you're into, maybe it's a retail building, maybe it's a mixed-use building, maybe it's a storage building. You're going out and you're buying this property, but you're not buying it to live in or use yourself. You're buying it to rent out to somebody else. So now you buy this property, you rent it out to somebody else, maybe they'll live in or use this property, and then in exchange for them living in and using your property, they pay you rent. Now the key here is this rent has to be enough to cover your property taxes, your insurance, your maintenance, your management fees, any vacancy costs, and then if you have any debt, cover that as well, and then put some money in your pocket each and every month. That's the right way to invest in real estate. You have some people, especially when you're in a very hot seller's market like we've been seeing, when you're in a very hot seller's market, you will see investors go out who have a lot of cash, just go out and buy properties and say, you know what? I'm okay losing money every single month because I think this property is going to be more valuable next year. So I'll be able to flip it for a profit. That's not the game that I play. That's too risky, that's too speculative because I have no idea where housing prices or real estate prices are going to be in a year. I don't like to play that game. What I like to do is I want to make sure I can make a profit in my cash flow every single month and just keep working to accumulate the cash flow. I just want to keep stacking the cash flow because now I know, okay, this property is going to make me $250 a month. If this property is going to make me $250 a month, I got to buy a second one for another $250 a month. After 10, I got $2,500 a month coming in profit. After 100, I got $25,000 coming in profit. And now it's a game of just stacking cash flow and how fast can I stack that cash flow. Now again, you don't have to be a real estate investor. You don't have to invest in stocks. But you have to start putting your money to work if you want to start generating the cash flow. There's some people on the internet that say that the only way to build wealth is to invest in real estate. Well, there's a lot of people that have become extremely wealthy without ever touching real estate. You have some people that say you have to go out and invest in the stock market if you want to be wealthy. Well, there are some investors that only invest in real estate that have never touched the stock market that have become extremely wealthy. What you need to do is find the right balance for you. Personally, I invest in stocks and I invest in real estate. It's just something that I'm interested in. You don't have to go out and blindly follow anybody else. You don't want to be a sheep. The idea is for you to go out and build your financial education, learn how to invest, and find the right strategy that works for you, that works for your family, and that works for your financial goals. Because at the end of the day, if you want to invest your money, you just want to make sure you get the best returns. For me, I like cash flow because cash flow is something that I can predict. And when I got the cash flow coming in, well, now I know I can go out and spend my money, at least the cash flow that I'm generating, and not really have to worry about it because even next month, I'm going to get another cash flow check. That's the way that I like to run my finances. So if you want to invest your money, you got to figure out the right strategy for you. And well, this goes over a couple ways that you can invest your money for cash flow. In this video, I want to go over 10 money habits that keep so many people broke. Now, I'm not talking about the plain old obvious bad money habits like not waiting for your paycheck and then going to a payday loan person who's going to take a big chunk of your paycheck to give you your money a few days early. And then you take whatever's left of your paycheck and then you go over to the Gucci store or you go over to the Louis Vuitton store and then you finance an ugly $600 handbag that you can't afford. I'm talking about the habits that aren't so obvious. For example, number one is taking money advice from broke people. I invest in real estate. I invest in single family homes and apartment complexes and mixed use buildings. And when I first started, I started off by investing in single family homes, which I would rent out. And a few people that I knew that were close to me started learning that I invested in real estate. Well, after I had a few single family homes under my belt, I went out and I was going to buy my first apartment complex. It was a small little complex. It was on sale for $260,000. And the reason why it was so cheap was because this complex was completely run down. It needed a ton of work. Nobody was paying rent there. It was essentially being used as a place where people would sell drugs. And so when some people who knew me found out that I was going to buy this complex, they had very negative opinions. You're going to lose money. It's too big of a deal. You're overpaying. The market's not good because this was still at the bottom of the 2008 crash. This was after that whole real estate meltdown. So there was a whole bunch of negativity towards this deal about how it's not going to work because of the type of building that it is and where it's located. Even though it was in a very good area, this wasn't in a bad city. It was in a great city. It was just a very rundown building that was being used for a lot of bad things. Well, I bought the property. It took me a little while to get it fixed up and renovated, but about 18 months after I bought the property, I had it fully leased out. Now I had tenants that were paying me rent every single month, and then a few years later, I sold the property for about $650,000. So yeah, it wasn't a bad deal, but if I had listened to all the broke people around me that had all the negativity towards the deal that I was doing, I wouldn't have made any money and I wouldn't have gone through with the deal. Here's the thing that you have to understand about listening to other people's advice. Sometimes people will give you good advice. Sometimes people will give you bad advice. Now, the reason why people will give you bad advice might be because they've never done this thing before, so they can't give you good advice. And the other reason why some people might give you bad advice is because, well, they don't want to see you succeed. Actually, let me rephrase that. Most people want to see you succeed. They just don't want you to be more successful than them. Everybody in the world has an opinion and everybody is going to give you their opinion. It is your duty not to just blindly follow everybody's opinions, but listen to them, learn from them, and then apply what's best for you. Because the reality is if you just blindly start listening to people who have never done what you want to do, chances are they don't know what it's going to take for you to get to where you want to be. Like if you want to be a real estate investor, you should listen to people who have been or are real estate investors. If you want to be a millionaire, you should listen to people who are millionaires. If you want to build a business, you should listen to people who have been entrepreneurs, but not just entrepreneurs, but successful entrepreneurs. It pays to listen to people who have actually done something because they're going to give you more brutal and honest advice versus people who are broke, who have never done anything, might just say something to make you feel good, or they're going to make you not do anything because they don't want to see you succeed or because they don't understand the concept of risk. Second is RSD. Restaurants, drinking, and smoking. The University of Chicago published a study covering the real costs of smoking. And what they say is that over the lifetime of a smoker, the costs that you have to pay are not just the cost for cigarettes, but you also have an additional cost for the additional health costs that you incur because you smoke. And then you have the financial lost opportunity costs because you spent so much money on cigarettes. You spent so much additional money on healthcare costs and services that now all this money that you spent could have been invested to make you wealthy. And the study shows you that over the lifetime of somebody smoking, many times the cost of smoking isn't just $100,000, but many times it's $700,000, $800,000, $900,000, or even over $1 million, depending on what state that you live in. All in all, the research shows that smoking will cost you $1.4 million over your lifetime. That's an expensive smoke. When it comes to drinking, I don't drink. But if you really want to drink, that's fine. But this is where you can be a little bit smarter with your drinking habits. Because I used to be in the event planning business. Meaning, I used to host parties, concerts, and shows back when I was in college and a little bit after college. And there's a lot of money that can be made by selling alcohol at clubs, at restaurants, and at bars. And the people that pay the money are the people that are drinking. Now, if you are struggling financially, you don't want to be spending your money on alcohol when you don't need to. Like if you really want to drink. Now, I don't condone drinking, but if you really want to drink, don't drink at the restaurant or the bar. Drink before you leave and have somebody drive you. Even if you pay for an Uber, it's going to be cheaper for you to drink at home than drinking at the restaurant and drinking at the bar. So if you drink at home and get an Uber, not only is it going to save you money, but now you don't got to worry about driving. And a hack that I used to use when I started eating at restaurants, because for a long time I used to go to restaurants with my friends, but I never ate there as a way for me to save money because I would eat at home because I knew it would be cheaper, and then I would just drink water at the restaurant. But when I finally started eating at restaurants, the hack that I would do was I would eat before I'd go to the restaurant. That way I didn't have to order an appetizer and I could just order my meal as a way for me to save money. So if you wanted to implement something like that, you could eat before you go, you could drink before you go, if you want to drink at all, but then you can go to the restaurant and just order some food. That way you don't have to pay for drinks, and that way you don't have to pay for an app. As a way for you to save money, but you still get the restaurant experience. The third habit that keeps so many people poor is that you have a small, limited mindset. If you make $50,000 a year, and let's say this pie represents your $50,000 a year income, well, you might want to put some money aside for your savings and your investments. And let's assume that you're putting aside $10,000 a year for your savings and your investments. So you're putting aside 20% of your income for your future wealth. Now, you might start liking this investment thing, and you like this idea of building wealth, and you're going to say, oh man, I want to put more money aside to buy more assets, to invest more money, to become more wealthy. And so what do? Well, you start squeezing more money out of the pie. Maybe you go to 15,000, maybe 20,000. And now what you're doing is you're trying to squeeze pennies out of your limited pie. And this is good in the short term, but it's not scalable in the long term. Because if you really want to become wealthy, what you can also do is, instead of just trying to squeeze more pennies out of the pie, is you can work to make the pie bigger. Because now if you go from $50,000 a year to $500,000 a year and you live off of the same ratio, well, now you can put aside $100,000 a year, which is the same 20% of your income, but now you have way more dollars being put aside towards your investments and way more dollars putting aside towards your savings to make you wealthy and to protect you against a financial emergency, but you also have so much money to live way bigger. So it's a way bigger benefit. Now you might be saying, but Jaspreet, how in the world am I going to go from 50 to 500? Well, this is where now you got to start thinking a little bit different. Because if you don't think or believe that you can go from $50,000 to $500,000, I can guarantee you're not going to take any steps to go from $50,000 to $500,000. But this is where now, if you believe that you can do this, if you want to do this, then you're going to start learning about how to do that. You'll start reading books about how to increase your income. You'll start watching videos on how to increase your income. Maybe you'll take a class on how to start a side business. Maybe you'll actually start investing into your own side business idea, your own side hustle idea, your own business idea. That way now you can start creating more income. Or maybe you'll start working as a salesperson. That way you can start adding some more commission to your life in addition to your job. There are so many ways to increase your income. It is going to cause more work. It is going to take more time. It's going to take more effort, but it is possible, because if your goal is to become financially wealthy, well, then you're going to have to start building this abundance mindset, because so many people get caught up on the idea of just squeezing pennies when in reality, a penny saved is just a penny. I'd rather you focus on the dollars, if not the tens of thousands, if not the hundreds of thousands of dollars, instead of just focusing on the pennies. Because now you're going to be able to build a lot more success, you'll be able to build a lot more wealth, and you can still enjoy your life as well. Now, if you want to learn more about how to invest your money smartly and you want to stay up to date on what's happening in the financial markets, well, that's why I created Market Briefs. It is a free newsletter to keep you up to date on what's happening in the financial markets. That way you can be a better investor, because when you invest your money smartly, you can also increase your income. Market Briefs is completely free, and if you're an investor who wants to stay up to date on what's happening in the markets, then you can join Market Briefs by clicking the link down in the description below. Number 4, you're spending money that you don't have to buy things that you can't afford. Now, in the beginning of this video, I gave the example of you going to a payday lender to get some money. That way you can finance a Gucci or a Louis Vuitton purse. Well, that's a little bit obvious, but now through the advent and growth of fintech technologies, you can now buy a whole lot more things that maybe you can't afford, thanks to things like buy now, pay later, or as I like to call it, broke now, broke later. The only people that are making money when you're borrowing money to buy things that don't make you money are the banks and the lenders. And you might be saying, but Jaspreet, the buy now, pay later stuff is free. It doesn't cost me any interest. It's 0% APR. Well, if that was the case, how come these buy now, pay later companies are worth billions and billions of dollars? And how are they making so much money? Well, it's not because they're not making any money. It's because they are making a lot of money. It's just many times hidden for people. The way the process works with anything, the 0% APR, is that now you don't have to feel the pain of spending $1,000 today. Instead, what you do is you're just going to pay it off in small little installments of $50 to $75 a month. And now what you do is you just bought yourself a $1,000 sofa, and it's only costing you $50 to $75 a month. Well, now that you have this sofa, you're going to need a new TV to go along with it. And if you want a good TV, it's going to cost you $2,000, but you don't got $2,000. You could go out and buy a $150 OK TV, but the $2,000 TV is only going to cost you $125 a month. So what do? Well, if you're like most people, you're going to buy the nice $2,000 TV and only add another $125 a month to your monthly payments. Now, you don't have to feel the pain of spending the $2,000. You don't have to feel the pain of spending the $1,000 on the sofa, but you have all the nice stuff. And when you keep doing this, now you have the ability to go out and buy more things, because you never had to actually feel the pain of spending the money. But you're also accumulating all these monthly payments, because now you have a whole bunch of stuff that you're going to be working to pay off over the next 12 to 18 months. And what ends up happening to so many people is you start making the payments, but you can't make the payments fast enough because you bought so much stuff. And now if you can't make the payments fast enough, well, now you get slapped with a big fine, and you got to pay big penalties, and you're going to have to pay a big interest rate, just like financing things off your credit card. So you thought you were getting free money, but the most expensive kind of money is free money, and this is where you want to be paying for things, especially liabilities, in full, not finance them, even if it's 0% APR. That way you never have to worry about the money. You never have to worry about the price later on. Number 5, you are overpaying on your biggest expense, which for many Americans is taxes. You have to pay taxes on everything. You pay taxes when you earn money. You pay taxes when your investments make money. You pay taxes when you sell your investment for a profit. You pay taxes when you buy things. You have to pay taxes on your home. You have to pay taxes on pretty much everything. But this is where you want to make sure you're also not overpaying on your taxes. And the more money you make and the wealthier you are, the more valuable this is going to become. If you are making over $100,000 a year, or if you have a business, you need to have an accountant who's going to help you manage your money and who's going to help you manage your taxes, because I am a licensed attorney and I can tell you that the IRS code is over 2,000 pages long, and it is going to be impossible for you to read the IRS code, understand it, implement it, and get the best tax returns for your money and still be able to operate your business or work your job. And so what you want to do is hire a professional who all they do is understand taxes, because now you're paying them to lower your tax liability. And there are many things that change year over year, where now your accountant's job should be not just to file your taxes, but to find the best deductions for you. That way you can pay less money in taxes legally. I'm telling you this from experience, because I have worked with bad accountants and I have worked with good accountants, and good accountants will pay for their expense many times over, because they will save you that much money in taxes and some, which is why you need to make sure you have a good accountant on your side. Now, if you're making under $100,000 a year, it might not make sense for you to pay a few $1,000s or more for an accountant or a tax professional. However, you still want to make sure you have some sort of software or something that can help you file your taxes and get all the deductions that you qualify for. There's a ton of softwares on the internet that can help you file your taxes at no cost. So just do your research and find an application, that way you're not doing it yourself. Number 6 is you want to get rich fast. Nobody wants to get rich slowly. That's not attractive and that's not interesting. Just like how building a six-pack in 3 years isn't very interesting. People want the six-pack next week. But the reality is, if you buy into the idea that you're going to be able to get rich in 6 months by following a simple 5-step plan, chances are you're going to fall into some type of scam, some type of get-rich-quick scheme that's going to make not you rich, but it's going to make the person selling the get-rich-quick scheme rich. And this is where you got to be able to decipher the difference between actually finding a good investment or a good business opportunity versus just some scam where it's just selling you some hypey product that's not going to do anything. Because the reality is, if you want to make a lot of money, it's going to take a lot of work. It's going to take a lot of effort, and it's going to take a lot of time. And if you're not willing to go through that pain, it's going to be very difficult for you to become successful, and you're going to keep buying into this whole dream and hope and desire of trying to get rich, because there's a lot of industries out there that prey on people wanting to get rich quick, that prey on people that want the nice things right now, that prey on people's desires and sell products which are complete crap to get you to pay them money for this thing. And this is where I want you to be a little bit more educated and understand that if it sounds too good to be true, it probably is. And if you just want that money right now, well, then you gotta be able to put in the work, because the more effort you put in, the more you learn, the faster that you'll be able to achieve that success. But understanding that if you're not willing to sacrifice that time, you're not willing to sacrifice that effort, well, then you're probably gonna buy into something that's a get-rich-quick scheme, and you're gonna be the one that loses the money to it. Number 7, you don't understand how our system works. We live in a capitalist system. Now, just that word makes some people very angry, and it makes some people very happy. I really don't care what the emotion is. What I'm trying to get you to understand is this is what the system is. So if you want to become successful in this system, you have to understand the way the system works. And in a capitalist system, you can make money one of two ways. You can make money from your labor, or you can make money from your capital. Your labor is when you go to your job. You work and you get paid. That's how most of us, if not all of us, are taught how to get paid, but very few people understand the second way that you can get paid, which is through your capital. And in a capitalist system, the people that make the most money are people who understand how to make money from their capital. And this is where now understanding how you can invest your money through your capital, because capital means money, that way you can make more money. Because some of the biggest industries, institutions, corporations in the world, how do they make so much money so quickly? Well, what they do is they buy an asset for a lot of money, like $1 billion asset, and then they sell it for a little bit more. If you buy an asset for $1 billion and you sell it for $1.1 billion, you just made $100 million. Now, I get it. You don't got $1 billion, but now you can start scaling this down more and more and more. Because now if you can buy an asset for $1,000 and you can sell it for $1,100, but now you just made 10%, which is the same as here, or $100 through your capital instead of just through your labor. This is where you buy an investment, you hold it, and you sell it for a profit. Now, if you can hold on to your investments for a longer term, you can see bigger returns. And if you can keep investing more and more money, you can also see bigger and more returns, because now you're constantly working to buy more equities, to buy more assets with your capital. And this is where you got to understand that the real wealth in this country is not built through working a job. When you work a job, you get paid, you get this cash, but now you want to convert this cash, this capital that you have, into an asset, because in a capitalist system, real wealth is built through owning assets through your capital. And the more assets that you can own, the more money and the more wealth that you will accumulate. But it requires you to put your money to work, even if you're starting with $10 or $100 or $1,000, because this is the same thing that the biggest institutions, the biggest banks, the biggest players in the world are doing, which is how they're able to make so much more money. You can see how big it is here, but it starts here. That way you can start working your way, flipping your way from 1,000 to 10,000, from 10,000 to 100,000, from 100,000 to 1,000,000. But you got to get started with the first 1,000 or maybe even the first 100. That way now you can start working to increase your income. And this might be through the labor market, through your work, but also through the capital market, through investing your money and putting your money to work. And this brings me to number 8, not thinking long term, because YOLO. Why would you want to wait to have a nice car when you can have the nice car now? Why would I want to wait to have the nice clothes when I could just finance them now? And we start developing the short-term mindset thinking, where we're only thinking about today, we're thinking about maybe tomorrow and perhaps next week, but the wealthiest people are thinking further out. When you start talking to millionaires and you start talking to people who are worth hundreds of millions or billions of dollars, they're not talking about what they're going to do with their money next week or next year. They're talking about what they're going to do with their money in a decade or decades from now. Broke people talk about what they're going to do tomorrow. And this is where now you got to start changing the way that you think. And if you really want to become successful, now it's about reframing how you're spending your money, how you're investing your money, and what your investment horizon is. Because the biggest key to becoming successful is not just how much money you invest, but how long you are investing your money for. Because the longer you can put your money to work, the bigger the wealth you will accumulate is. Number 9, you're focusing on the price more than the value. Have you ever heard something like this before? $400 for a class? Are you crazy? Or $3,000 for coaching? Are you out of your mind? Or $30,000 for consulting? No way! All of these objections focus on one thing, price. But what you're ignoring is the value that you get. I mean, if you pay $300 or $400 for a class, but you can make $1,000 from the education that you get, is it worth it? I'll leave that up to you. If you pay $5,000 or $4,000 or $10,000 for coaching, but you can make 50 grand, is it worth it? Well, I'll leave that up to you. If you pay 30 grand for some sort of consulting, but you can learn how to make an extra 100 grand, is it worth it? Again, I'll leave that up to you. When I was first getting started as an entrepreneur, I used to hesitantly buy some of these $1,000 classes. But what ended up happening through each one of these $1,000 classes wasn't that I saw this breakthrough thing that I've never heard of before, but in each one, I found one thing in each one of the classes that made me many times more how much I paid. Sometimes $5,000, sometimes $50,000, sometimes hundreds of thousands of dollars from one thing, one lesson that I learned from paying $1,000 for an entire class. Then as you start to progress and you make more money, well, the cost of education also goes up. Now you go from paying $1,000 for a class to $3,000 to $10,000 for coaching. And at first I was like, oh my God, that's a lot of money for coaching. And then you do it. And it's the same thing. You learn a couple things now that can help you, hopefully, make at least 5 times more what you paid. And then you go on to consulting, people that are actually going to work with you in your business. And now this is going to cost many times more than that, where now I'm paying sometimes more than $100,000 for some sort of consulting. But why? Again, the goal is to make many times more than what you pay. But it requires work and it requires an investment on your end, because if you're not willing to work, then it doesn't matter how much money you pay, you're not going to get anything out of it. So you have to be willing to invest in yourself, but you also have to understand the difference between price and value, because sometimes, or many times, people get so hung up on price. This thing is expensive, but you're completely ignoring the value that you're going to get. And if you want quality, if you want things that are higher end, it's going to cost you more money. Now you just have to understand what things do you want to invest in for the quality. Like for me, I invest in quality education, quality consulting, quality coaching, but also on my own personal side, I like investing in things, or not really investing, but buying things that give me quality in terms of travel. I like traveling in comfort. I like having nice places to stay. I don't really care about having a really nice car right now, but I'll spend more money on a nicer Airbnb. And this is where you got to understand what type of things do you want to invest in more? What type of things do you want to pay more money for? What quality matters to you? And make sure that you're getting the value, but you're spending not based off of price, but value on the things that really matter to you. And number 10, your life revolves around money. There's a good quote that I really like. It says, some people are so poor that all they have is money. Money is important. Don't let anybody tell you otherwise, because if you don't have money, you're not going to be able to pay your bills. You're not going to be able to have the lifestyle that you want. You're not going to be able to give your spouse the life that they want. You're not going to be able to give your kids the education that they need. You're not going to be able to give your kids the vacation that they want, and on and on and on. If you don't have money, you're going to face a lot of money problems, but money can only solve money problems. More money is not going to make you happy. More money is not going to make you fit. More money is not going to make you find a spouse. More money is not going to find you all these things that you need in your life. And this is where you got to understand how you can live a more holistic life. Money can help you buy a better gym membership. It can buy you better food, but it can't change your mindset to actually go to the gym, and it can't stop you from eating at McDonald's every single day. So this is where you got to understand how money impacts the different part of your life, but understand that we're living lives here where you have families, you have your physical health, you have your mental health, you have your spiritual health, and the financial health. And the things that I talk about here focus primarily on the financial health, because these are things that I wish that I would have learned, and these are things that I feel like I have learned and done a pretty good job at. But I also want you to remember that on your journey to wealth, there are many more things that matter in addition to money. So don't just completely ignore everything else, and remember how the different aspects of life play a part in your life. That way you can live a happy life and also a wealthy life. We have this culture where it is very normal and glorified to almost be bad with money. People like complaining about money problems on social media. They love flexing all the nice stuff that they can't afford on social media. And so what I want to do today is talk about some of the most important money habits that you have to have before you turn 40, because now until that time you want to be making sure you're working on these money habits to get it all in place. That way you can really set yourself up for financial success and wealth. And it all starts with number 1, stop bleeding cash, and in this case, knowing how to pay down your debts. Because when you have consumer debts that are consuming you, which are your student loans, your credit card debts, your home equity lines of credit, your hard money loans, your payday loans, your buy now, pay laters. These types of debts are where you're spending your income today to pay off all the liabilities, all the luxuries, all the consumer expenses that you couldn't afford yesterday. When you get stuck in this type of rat race, all you're doing is you're going to work today to pay off your banker for the things that you bought yesterday. I was watching a podcast yesterday, and what they were saying was the number one way for you to become wealthy and set yourself up for financial success is to pay off your student loans before you turn 30. And that's a great thing to do, but what happens now if you have $500,000 worth of student loans because you went to medical school and you didn't graduate until you're 28 or 29? Or what happens now if you're 22 years old and you have $40,000 worth of student loans and you don't really start paying it off until you're 28 or 29 or 30? And so yes, if you can pay down your student loans ASAP, that's great, but by the time you're 40, you have to know how to pay it off, if not pay it off completely, because this is where it's not just your student loans, it's your student loans, the credit card debt, all those debts that are for your consumer liabilities, the things that are not putting money in your pocket. If your debt isn't paying for itself, because even student loans fall under this category, if your debt isn't paying it off through its own asset, you need to pay it off as soon as possible. Now, as much as people try to strategize the best way to pay down debt, at the end of the day, the debt strategy method ultimately comes down to this. This is your debt that you have, and if you want to pay it off, you need to have cash to throw at your debt to pay it off. And there are two ways to get this extra cash. Either you can spend less money, or you can earn more money. In either of these cases, this is going to give you a bigger margin, because now you have your income and your expenses. Either you can increase your income, or you can cut your expenses, or you can do both at the same time. This is going to give you a margin, which means you're going to have cash that you can use to attack this debt and pay it off. And the faster you pay it off, the less debt that you're going to have to pay, because, well, the less interest that you pay. Because now the more you pay today, the smaller your principal balance will get, and the smaller the interest that you're going to have to pay now, because because your balance is getting smaller. So it literally pays off to attack your debt sooner rather than later. This is where people try to get into the nitty-gritty. Should you follow the Dave Ramsey model, which is the snowball model, where you're paying off the smallest debt balances first and then you're gradually getting bigger and bigger and bigger? Or do you follow the debt avalanche method, which is now you're paying off the highest interest rates first? It really doesn't matter. The key here is the more money you put in towards your debt, I don't really care which method you follow, the more money you put in towards your debt, the faster you're going to be able to pay this off. And once you stop having this debt, once you stop bleeding cash, now you could take this extra money, this margin that you have now, and put it to work to make you wealthy. Because when you get stuck in this system of constantly just having all of your money going out to pay your banker's the one that's getting rich, but you are now working to keep your banker rich. So you want to pay this off as fast as possible, that way you can use your money to make yourself rich. The second money habit that you have to master if you want to become wealthy is you have to know, how do you spend the money that you have? Because we live in a society where you don't have to be able to afford something to be able to buy it, because you can buy pretty much whatever you want thanks to the help of credit cards and lines of credit and buy now, pay later. But that's going to put you right back into the problem that we just solved, is how do you pay down the debt? Because now when you're just buying things that you can't afford, well, now you are going to spend tomorrow's income paying off your yesterday's expenses. So what you want to do now is you want to understand the difference between being able to buy something and being able to afford something, and then spend your money based off of that. Dave Ramsey said it the best. He says that you need to act your wage. And the way that you can do that, the simplest thing that you can understand is my rule of 5 when it comes to your liabilities, which are not necessary to you living your life. And that means in the rule of 5, if you cannot buy 5 of them, you cannot afford 1 of them. It's a very simple rule of thumb that will help you understand what you can afford and what you can't afford. And this also means that you have to understand, how do you spend money on things like your car? Because pretty much everybody thinks it's normal to have a car payment, because now when you want to buy a car, who is going to pay for a car in cash? Because now you can either lease it or you can have a car payment. Now leasing can work for some people or business owners in some situations for the tax purposes, the tax advantages. But I want you to think of leasing like flying first class. It is not the cost-effective way to fly. It is a luxury, and you're paying extra for that luxury. That's what you get when you lease a car. So leasing is buying that extra luxury. It's flying first class. You're buying the extra luxury of being able to now switch cars and do everything that you get with a lease. Now, when it comes to actually buying the car, if you want to buy a car and you can't afford to fly first class, you shouldn't be leasing. Now you're comparing, okay, do I buy it with a car payment or do I buy a car outright? Right now, at the time of me recording this video, the average car payment for a new car is $644 a month, and the average payment on a used car is $488 a month. Now, not only do you have this car payment, but then you have to pay for your insurance, you have to pay for your car registration, you're gonna have to pay for your maintenance, and when you got the nice car, you also gotta pay for your premium gas. And then what happens to so many people is you get into this car payment game, where now you buy this car, you own it for 4 to 6 years, and then you pay it off, and then as soon as you pay it off, you feel a little weird because now you have a car with no car payment. So what happens? That's when people go out, they sell this car, and then they go and buy a new car, and then they start this car payment game all over again. So you just finally paid off the car, but then you started all over again. So then people keep these car payments going forever because it's so normal to have these types of car payments. But let's do the opposite now. What if instead of having a car payment, your car payment was going to invest in you? That way you can become wealthy. So let's just assume now that you took $550 a month, and you, instead of buying a car, you use this money to buy you investments, whether it's on the stock market, maybe you're building up a real estate fund, because now with real estate crowdfunding, you can invest $500 a month, but you're investing $550 a month, and you would get just a 7% average return on your money. And you do this from the time you turn 21, which is when many people start this car payment game. And you do this until you retire. And you don't increase the amount of money that you're investing every month, even though your car payments are probably going to go up every 5 or 6 years because you're going to keep buying more and more expensive cars. But I'm going to assume now that you're only going to pay $550 a month into your investment portfolio every month from 21 until retirement. Well, if you do that for 45 years, guess what? You're going to have a retirement portfolio of over $2 million. Versus if you just pay this $500-600 a month for your car every single month, after you get to retirement age, guess what? You're going to have a car worth next to nothing. cars lose value each and every day. Sure, maybe your car, if you have a nice car, will be worth $20,000, $30,000, $40,000, maybe 50 grand, but that's not $2 million because here you're buying assets. Here you're investing this money into yourself to buy an asset. Here you're taking this cash and you're paying interest on it to buy a depreciating liability, something that's dropping value each and every day, and then you're paying interest to the bank on top of that. Now you might be saying, but Jaspreet, I need a car to get to and from work. Yeah, you're right. But do you really need a $40 or $50 or $60,000 car? I like nice cars. I want you to have a nice car, but the thing that I want you to understand is that your car is a liability. It's not making you any money. I still today drive a car that's worth about $500. Actually, 2 days ago, I got a call from my homeowner association because my car, it doesn't have a bumper on it anymore. And they called me and they said, hey, we got a couple of complaints from your neighbors saying that there's a black car in your driveway that's an unusable car that's just sitting there because they thought that it was a junk car sitting in my driveway, and they said that I should put my car into a storage unit. And I said, excuse me, well, this car takes me to my office every single day. I've been in California for a little while, so I guess that's probably why they were getting these complaints. But I drive my car to work every day and it takes me everywhere. And yeah, while I don't have a bumper, everything else is working. Now look, I make a good income, and yeah, I probably will buy a very nice car someday. But for me, I understand that my car is a depreciating liability, and right now I'm investing very aggressively. I don't want to spend 100 grand or 200 grand on the car today because I know that I'm going to take this cash and I can reinvest it. I can put it back into my business, market briefs. I can take this money and go out and buy stocks. I can go out and buy real estate. I can find the other opportunities because I am so focused. I am laser focused on building this thing that I never had, this wealth that I never had before, because I know how important it is for me, and I'm willing to sacrifice that nice car today. I will buy a nice car. Okay, I'm not saying you gotta drive a junk car for your whole life. I'm gonna buy a nice car. But I understand how it plays a part in my life because I understand the difference between an asset and a liability. And I'm more focused on building this than I am focused this. This is my number one priority. This, well, my car is just taking me from A to B, and when I'm ready, I will buy another car. The third thing that you have to understand is how do you invest your money? And when I say how do you invest your money, I don't mean putting your money into your 401k or your IRA. If you're doing that, fine, but that should be the very base. That should not be the tip and end of your investments. You need to be investing your money yourself. Now, if by this time you realize, okay, I suck at investing my money, I hate investing my money, then maybe you can consider getting some sort of financial advisor or money manager to help you with that. But if you don't, now you got to figure out how you're going to be investing your money yourself. And what you're going to realize is maybe you're going to like stock market investing. Maybe you're going to like real estate investing. Maybe you're going to like cryptocurrency. Maybe you're going to hate stocks but love real estate. Maybe you're going to do something like that, but you have to understand how do you invest your money. And this starts with the basic education of understanding how you get paid. Because the way you get paid is going to dictate how you invest your money. Because you can get paid from cash flow, which I'll label CF, or you can get paid through appreciation. And this is when your investment value goes up. The reason why I love investing in real estate is because I can get predictable cash flow from my real estate. So the way it works is once you buy a property, whether it's a home, an apartment complex, whatever it is, you buy this property, you own it, and now you're going to rent it out to somebody else, and somebody else is going to be living here. I'm going to draw this person right here, draw him a nice mustache, or as we like to call it in my native language, Punjabi, a much. This person is going to be living in this property, and then they're going to be paying you rent every single month for living in your home. Now the nice thing is, once you understand the ropes, once you understand how it works, it's going to be very passive on your end. Like, I don't know who my tenants are. I don't get involved with the day-to-day maintenance. I'm not involved with paying the bills. I have a property management company who the tenants deal with, and they do all of that work A to Z. But what they also do is make sure that I get paid. They deposit this money into my bank account. Now, of course, the property management company takes a fee, right? They're going to charge you money, so your rents are going to go down a little bit, but it gives me back my peace of mind. It gives me back my time, because now that I own the asset, this asset can generate me cash flow forever, as long as I own the asset and as long as the asset exists. And now I'm getting this cash flow, because now if you could think about it in terms of stacking assets, well, for me, I know that every house that I buy, it might put between $500 and $700 into my pocket of profit every single month. And so now it's just a game. How do I stack more? If I have 10, that's 5 to 7 grand of cash flow every single month, essentially passive, that I don't have to go and work for. If I can get 100, I know it's going to seem really far away. How in the world can you get 100? Because that's very hard, but that would be $50,000 to $70,000 worth of cash flow every single month. Now the question is, how do you put it in action? How can you buy 1 a year? And then as you start to grow, maybe 2 a year. And it's all about putting the plan in action, because the hardest one is the first one. But this is one way that you can get paid, is through cash flow. The second way is through appreciation. Appreciation is when the value of your asset goes up. Now you can do the same thing in real estate, where people will go out and buy a home for, say, $200,000 and then hope that this home will be one day worth $300,000 and then sell it for a profit. But I don't like to do that with real estate, because with real estate, I'm buying this cash flow. The people that get burned the most in real estate are the people that do this. They start looking for these speculative properties. They're hoping that they're going to be able to sell it for a quick profit. I don't like doing that. I'm not a trader. I'm not a flipper. I like to be a long-term investor, which is why when I invest in real estate, I don't care what's happening with housing prices. The only thing I'm looking at is how much cash flow that I'm getting. However, you can build this appreciation as a long-term investor. Because remember, there's a difference between trading and investing. Trading is now when you're trying to flip something. You buy something for 100 grand or 1 grand or $100 today, and then you hope that you can sell it for 50% more in the next 6 months. I don't play that game. So when it comes to appreciation, I'm looking for now investments that I believe in for the long-term value. This can be stocks on the stock market. It could be my real estate, where I'm not buying it for the appreciation, but if I get appreciation, that's icing on the top. Or it can also be cryptocurrency, if you believe in crypto. If you don't believe in crypto, don't buy crypto. But now, the whole idea here is you want to look for these investments that you can hold on to for the long term. And by long term, I don't mean 6 months. I don't even mean a year. I'm talking about multiple years, if not decades. So now, this is something that you believe in, that you want to hold on to for the long term. And in the stock market, if you don't want to get into the business of finding, researching, and investing in individual companies, well, then you can also invest in ETFs. An ETF is an exchange-traded fund that gives you exposure to a lot of different stocks. So now you can invest in ETFs that give you exposure to the 500 biggest companies on the stock market, the S&P 500. You can invest in ETFs that give you exposure to tech stocks. You can invest in ETFs that give you exposure to energy stocks. You can invest in ETFs that give you exposure to healthcare stocks. So if you know what it is that you want to invest in, but you don't know the best company to invest in, then you can just invest in an ETF. And now, if you're still like, I don't know how to go about doing that, well, then what you can do is just set up a passive and automated system where now every week you have some money that's automatically leaving your bank account and automatically being invested into the ETFs that you want to invest in. I have one of these set up where every single week, for me it's on a Wednesday, it doesn't matter what day you pick, but every Wednesday money gets pulled out of my bank account and it gets automatically invested into my portfolio of ETFs. So that is my passive strategy, but then I also have an active strategy where now I'm looking for good investments, whether it's in the stock market or the real estate market or the crypto market or with startups. I'm looking for these good investments, and then when I see a good buying opportunity because prices go down, well, that's when I come in and buy. Typically, now it's becoming a little bit more awareness of this on YouTube thanks to education on these platforms, but typically what happens is when these asset prices go down, people get scared, they run away, and then they sell. But for me, that's a great opportunity to buy. Like I was buying when the 2020 crash happened. I was buying pretty aggressively. I was buying real estate after the 2008 crash happened. I was buying cryptocurrencies when we saw the last cryptocurrency crashes. So for me, crashes and down markets are opportunities for me to buy instead of opportunities for me to panic and sell, and that's where you want to find the right opportunities there. Now you can also generate cash flow from the stock market. Like if you invest in a dividend paying company, some companies have a big profit at the end of the year and they'll just give it away or most of it away or some of it away in the form of dividends, which is literally just like a cash payment to you and it gets automatically deposited in your account. Many companies pay a dividend every quarter, meaning every 3 months. And so if you invest in these dividend-paying companies, your goal is, again, seeing this appreciation, meaning seeing the long-term value of your stock investment go up. But in the meantime, you're getting paid while you wait because you're getting this sort of cash flow. So if your goal is just to build another stream of income, you want to have another stream of income coming in that's passive, well, then what you can do is you take that passive investment strategy that I was telling you about and now look for either dividend-paying stocks or dividend ETFs. That way now you're just working over the years to build up another stream of income, because if you do that and you stay consistent with it and you do it for years, you do it for a decade, what you're going to see is now all of a sudden you have just built a brand new stream of income, and the goal is for your stream of income to replace your job income. That way now you're working for your job income, but then you also have your passive income from your dividends or your real estate that's paying for your lifestyle. So now you just doubled your income without doubling your work, because now your dividend income is paying you without you working, and then your job income is paying you with your working. And then whenever you're ready, you can either cut down hours from your job or you can keep working a job. That way you can keep building up your investment assets. But the key here is you need to know what your goal is. Do you want this? Do you want this? And know where it is that you want to invest. The fourth habit that you have to understand is now, how do you save money and where do you save money? So the basic end of this is you got to know how to live below your means. By the time you're 40, you have to know how to spend less money than you make, but you got to understand then when and how do you save money, and when is it right for you to spend money? Because when you save your money, well, there should be a reason. And what I like to say is that you should be saving money for one of three reasons. You should be saving your money for an emergency, you should be saving your money for an investment, and you should be saving your money for big purchases, and that's it. If you're not saving your money for one of these three reasons, then you are not saving your money smartly. So every saving dollar that you put aside needs to have a strategy and a reason to be saved. Now, when it comes to your emergency savings, you want to have somewhere between 3 months and a year's worth of expenses saved, depending on what your risk tolerance is. If you hate the idea of taking risk, if you don't like the idea of investing, then put aside a year's worth of expenses in your savings, because that will even cover you through the worst case scenario, and then invest everything after that. But if you have a higher risk tolerance, then maybe you only need 3 months worth of savings put aside. But then this also goes to now, how do you now save strategically when it comes to your spending? Because in the beginning, we talked about spending your money when it comes to most of your expenses. But now, as you start to become a little bit more financially savvy, as you start to build wealth, you want to be spending your money the smart way and not just saving every penny because, well, you can. Because the ultimate goal of having money is to be able to use the money, because if you don't use your money, it doesn't give you any value. So now the question is, how can you put your money to work and use this in a way that's going to give you the most benefit? Like, one thing that you can do, which is what wealthy people do, is they use their money to buy back their time. So if there are things that you hate doing, maybe you don't like going to get groceries. I hate going to the store. If you don't like going to groceries or getting groceries, you don't like cooking your own food, well, then now you can use your money to pay somebody to do that. Now, there's an added cost there. You got to pay somebody to get your groceries, so you're going to pay a premium for that. If you're going to hire someone to cook for you, there's a cost to that, but you're buying your time back. And now, as you're on that journey to build wealth, you have to start valuing your time. If you can pay somebody $25 an hour to cook for you and your time is worth $50 an hour, well, you just bought your time back and made a profit. This also means you got to understand what's important to you. For me, name brand stuff and a nice car aren't on the top of my list. However, I do like comfort and I do like certain luxuries. Like if I fly international, if I'm going to India to visit family, that is a 20-hour journey on a plane. Well, on that plane ride, for the most bulk of my life, I was flying economy in the back seat, sitting like a sardine. I don't like doing that anymore. So now I'm willing to pay for that added comfort of sitting in business class or first class, which costs significantly more. I mean, it costs like 5 times more to sit in a business class or first class seat when you're going international, but it's worth it to me. So I will pay a lot more money for that because that value gives me value, something that I want. And when I travel, I like to be able to travel. So I spend money on traveling. I want to have a nice hotel room. I used to be the one that would fit 10 people into a $24 or $44 a night hotel or motel room. Now I'm getting nicer rooms. I want that nicer comfort there because that provides more value for me. And you got to understand now, how do you save strategically? So we talked about the 3 places, right? The reasons why you save your money, but now don't just save all of your money to save it as you start to get deeper into your wealth journey. Figure out what's important to you. Spend money on the things that provide value to you. And the things that don't provide value, well, yeah, you can make those sacrifices because it's not that important to you. If you keep living that life where all you're worried about is what other people will think, well, you're going to be spending your money to make other people who don't really care about you and people you don't really care about, you're doing it just to impress them, but no one really cares. You're blowing your money on the things that don't matter, but this is where you got to know how to do it the right way. And this brings me to number 5, which is you need to know how to protect your wealth, because now as you start to build more wealth, what you're going to realize is when people realize that you have money, they're going to try to take their hand, put it in your pocket, and take some of your money for them. And you will see this in a number of different ways. Maybe people will try to sue you. Maybe it'll be in the form of taxes. Maybe it'll be something else. But this is where you have to know how to protect yourself legally and financially by building shields around yourself. And I'm telling you this from personal experience. Like, my first real estate deal ever was the most difficult and probably one of the biggest headaches. Now, it was a profitable deal. I still own that property today, but I learned a lot from it. And my first tenant also sued my real estate company because the claim was that my bathtub in that property was too slippery when the water was on. So the claim was that because they would turn the water on, the bathtub would get so slippery that it caused this person, one of the tenants there, to slip and fall. And because of that, they were suing my real estate company. Now, the interesting thing was, then the reason why I have a property management company is because they document everything. They refused to let my contractors in after that happened because they said that there was a chip in the paint on the bathtub, which was about the size of a quarter. So that chip of paint, they said, contributed to the bathtub being slippery. However, they did not let us make that repair. And second, they'd also admitted that the reason why they don't want anyone to make a repair there is because the person who slipped fell at a barbecue playing some games, and that's where he got hurt. And so because he fell at the barbecue, that we can't come in there. So we had all this documented, so it was a frivolous lawsuit. The judge threw it out. However, it was something that I had to go through and learn because in America, you can sue anyone for anything. It's just the way the system works. So how do you protect yourself? Well, for one, if you're investing in real estate or if you have a business, you want to have a legal shield. Maybe you create an LLC or an S Corp or maybe a C Corp, depending on what your company is. You got to talk to a tax professional or an attorney in your area. Most of the time, probably an LLC or a S Corp is going to do the job for you. And then once you have your business entity set up, you also want to make sure you have insurance. You got to have insurance for your property, your properties. You got to have insurance for your business. If you own a business and you have employees, you got to have separate insurance for that. So you want to make sure you have your different insurances set up. Have health insurance for yourself. Have health insurance for your family. Have your insurances for your property, your personal property, your car, your home. You know, all these things are not fun to have. Maybe you have life insurance as you're working to build your wealth. Life insurance is something that can provide you the sort of bridge insurance as you're building your wealth and owning assets, because your goal should not be to rely on your life insurance to take care of you or your family. Your goal should be for your assets to take care of you and your family. So that's one of the things that you can have set up. And then you want to make sure that you talk to an attorney, an estate planning attorney. An estate planning attorney is going to help you now understand how do you put all of your assets together. That way, whenever your time comes, because all of us have a limited time on this earth, how will your assets get passed on? Maybe you have a will, maybe you create a trust, maybe you do some other sort of fancy estate planning, depending on how much wealth you have, on how you can start planning to pass your assets down to somebody else. So these are things you need to plan for, because if you don't, then you're going to run into a situation where you can create a lot more risk, a lot more fights within the family, a lot of other issues, but you can avoid all of that by just planning for it. Now, I know no one likes to plan for worst case scenarios. Like, insurance is not something fun you want to pay for. No one likes to plan for what happens after you die. But the reality is, if you don't, and something bad happens, well, you're taking on all the risk, and it can cause a lot of issues when you can prevent all of it by just protecting your wealth and taking these precautions when times are okay. I mean, it's just like investing your money. How do you take advantage of a market crash? Well, you learn and you put money aside when times are good. So it's preparing when times are good for a bad time. And it's the same thing here, where you want to prepare for when things go wrong during a good time. Currencies, people assume that if I put my money into this thing today, 6 months, I'm gonna double my money. Sure, maybe that might happen sometimes, but now you're playing the lottery. You're gambling. You might win some, but you're gonna lose more than you win. But if you really want to win, if you really want to build wealth, if you really want to build a sustainable wealth, if you want to follow the proven path that has made more wealth than anything else, it's